Of trading for the Spanish banking business. And Airbus in focus. According to people familiar with the matter, delivering about 60 planes in June. That takes them to slightly more than 300 in the first 6 months. That's well short of halfway to 820, which is their target for the full year, Guy.
Yep, it's always challenging targets, and it always gets pushed towards the end of the year, and that's when the catch-up happens. Let's talk about today's trade, talking of catch-ups, and show you what is happening here in Europe. We are anticipating a positive start to the day. Not that positive, a little tick higher. Certainly that's what we're getting early on from the FTSE 100. It's a bunch of single stocks that are probably quite interesting today, maybe more interesting than the index level story. But the stock 600 also up by 0.2%. I think that's going to be the broader picture. You may get a little bit more maybe out of the CAC 40 this morning, so we'll wait and watch and see exactly what that market delivers this morning. But remember, there are significant catalysts emerging. Got payrolls that you've got to think about tomorrow. That's going to be the big story. NFP is out of the States. Plus, we've also got the trade narrative emerging as well. We don't know what's going to happen with the big, beautiful bill. There's lots of things that are kind of out there right now for the market to think about. So steady as she goes, maybe is the narrative. Little creep higher, but steady as she goes. What's the sector story, Critty?
Well, right off the bat, you are seeing a little bit of outperformance in some of the banking sector. I think that's interesting because there are key ones in Spain that we've got our eye on. Broadly, green on the screen, Anna, across the board. But it's the banking sector that, of course, is really keeps catching my eye. I'm going to try to get these words right. I want to get to Spain in just a moment, but your biggest index contributor this morning is actually HSBC. I'm seeing BNP, I'm seeing Barclays and BBVA, and, of course, Santander all in there. So in addition to, of course, what's going on in the banking sector specifically, seems to be a little bit of a cyclical tilt this morning.
Right, and Sabadell, very specific to that deal, the sale of the TSB business to Santander. So Sabadell up by 2.3% or so this morning. So it does seem as if we're seeing it stick to that side of the trade. Santander up by 1.5%. So in fact, both of those rising. To your point, Gritty, seems to be about something bigger than just Spanish banking. If both sides of that deal are on the rise today, and in fact, very few banks in Europe are in negative territory. It's the best performing sector, along with energy, which is not doing too badly this morning. But most sectors in positive territory, Guy. In fact, nearly all of them. Only personal consumer, discretionary, grocery stores. That is the only sector that's moving lower. M&S, one of the names in the mix there on the downside.
I'm distracted by the gilt market. We are seeing a little bit of a pickup in yields this morning, but it doesn't look extraordinary. In fact, it looks pretty much in line with what we're seeing across the whole of Europe. So UK 10-year now yielding 446, 447. We're up by 1.3. Italy's up in terms of yield, moves more than that. France is up kind of pretty much in line with that. So this doesn't look like it's out of kilter with what we are seeing elsewhere in terms of the moves that we are getting, despite the fact that the UK now has a bigger hole in its budget.
5 billion, it would seem. That's
could be more. Apparently, this actually may end up costing money.
Right, so the 5 billion from yesterday, we also already had the backtracking on the other way they were trying to get fiscally in line, and that was around the winter fuel payments, of course. We've heard from the front bench this morning, UK welfare concession costs will be set out in the budget, according to Pat McFadden, who is a UK cabinet minister, of course, and speaking elsewhere this morning. It will have financial consequences, he acknowledges. But to your point, Guy, this does not seem to be what is driving gilt markets today, perhaps other global trends in the driving seat.
Well, let's talk about one of those global trends, which, of course, is the fact that we are barreling towards the July 9th trade deadline. Is that something that's priced into these markets? We spoke to Marina Zavalok, Chief European Equity Strategist at Morgan Stanley, about the range of outcomes for European equities off of those U.S. tariffs. Take a listen to what she had to say.
20% is not priced in. I mean, we have a scenario where, let's say on July 9th, we go back to 20%. Theoretically, that could cause more than 10% downside to the European equities index. But I think given that the market has gotten used to things coming into play and then being taken off, probably investors would not price that 10% downside fully. It would be more like a 3 to 5% downside risk.
Joining us now this morning, Eric Waitenis, EMEA Head of Investment Strategy over at JP Morgan Private Bank, joins us around the table. Good morning. Thank you for joining us.
Good morning.
We just heard Marina over at Morgan Stanley talk about this idea that 10% is priced in, 20 is not. Is there a magic number for you that this equity market is looking at when it comes to tariffs from the States?
I think we would largely agree with that type of range assessment. An expectation that the ultimate landing zone for tariffs is in that low double-digit type of area is something that the market seems comfortable with, has its head around, and would ultimately be palatable and acceptable on a go-forward basis. If we got to that high double-digit type of zone, maybe that 20% handle, the market would take it more poorly. But we have a degree of optimism that some common ground can be found here, and markets and economies are showing a lot of dynamism and flexibility to make their way through this adjustment period.
But that talks about country tariffs or regional tariffs. Talk to us a little bit about sectoral tariffs. Is that something the market should be pricing in right now?
It seems as though it is. If we land at an ultimate across-the-board rate that is not disruptive enough for global trade, and then we have these different targeted sectors, exceptions on different key industries, that again seems to be in a place that the market is thinking about what this means on a go-forward basis. There's a degree of reflexivity to the way in which global trade is occurring right now. If you take a look at China, for example, there seems to be a degree of pivoting that's happening to different countries. Goods are still making their way around the world, and growth has proved to be pretty resilient as we look forward.
Are your customers comfortable being risk on at the moment with this equity rally?
So I'm glad that you mentioned that word, because the title of our mid-year outlook was actually comfortably uncomfortable. We thought it was kind of clever. And I do think that it is requiring, or the market circumstances requiring, a recognition that this is a bit of an outside-the-box type of year so far here in 2025. But if you look through a lot of these geopolitical events, policy events, and so forth, the reality is that plain old-fashioned earnings and economic growth have been continuing to come through.
Yep.
And at the end of the day, earnings is what it's all about, and we remain constructive.
Is there a different view from your US customers versus your international customers? Do they share the same views at the moment? You look at, there's a big move in the dollar. There's talk of the fact that international investors aren't putting money to work in the United States. Is there a difference in the way that they are approaching how they are investing at the moment?
I would say the biggest difference is probably the degree of sensitivity to FX or lack thereof.
Right.
So what I mean by that is our clients in the U.S., they do tend to be a little bit more U.S. dollar and U.S. asset centric overall. Here in the region, there's a bit of a debate going on in terms of how much do I want to be allocated, or how much the clients want to be allocated to the U.S. relative to ROW, rest of world. And I think there's two main ways to think about this. Way A would be the viewpoint that you sell the U.S. to invest internationally. View B would be you stick with your well-performing U.S. assets, which we think there are a lot of good reasons they will continue to perform well, and you add incremental international exposure. What you accomplish there is a greater degree of international diversification, and then you also lower your percentage concentration in the U.S. We think that's the right approach. Version B, add international.
So adding international, but sticking with some of the things in the US that you like. So that takes us into the second half of the year, because we saw it was the first trading day of the second half yesterday, and we saw some interesting things. People taking profits on the things that had done well in the first half. Is that going to be a theme we continue to see? I mean, for example, small caps were doing well yesterday. It was only one session, and we had some interesting JOLTS data that moved the market. But what are your expectations for the rest of the year? Does it look like the first half, Eric, or does it look really different?
I am skeptical it can be quite as eventful as the first half of the year, but I suppose time will tell. You mentioned JOLTS. I think that the next 3 labor market reports in the U.S. in particular are going to really matter. Now, the U.S. labor market report, of course, always matters, but in the next quarter or so is going to be more so in this tariff digestion period. So I think it will have an even more keen eye by market participants and the Fed as well. In terms of investments and sectors, we continue to lean into and favor financials, tech, and utilities in the U.S. One of my favorite stats about the AI theme at the moment is this incredible increase in the rate of adoption of AI. It was essentially 4.5% of U.S. firms are utilizing AI only 6 months ago. That has gone up to about 9%. So that's a 2x in just 6 months. And furthermore, the rate is increasing in its degree of increasing as we go forward. The curve is kind of bending, so to speak, and inflecting higher. And we think that's powerful for the tech sector.
Okay, so still AI enthusiasm in the United States. Defense enthusiasm here in Europe? I mean, that's been a big talking point in the first half of the year. I'm interested how clients are thinking about exposure to defense at this point.
We like it. We have been aboard that theme and continue to have that viewpoint. It is very noteworthy and impressively decisive, I would suggest, this increase in NATO commitments in the region. And we really like seeing that sense of urgency out of European leaders, either on defense, elements of the Draghi report-oriented recommendations, infrastructure, investing for future growth. There is a greater degree of tangible optimism here in the region, and we think there's good and valid reasons for that.
Can we talk about one of the major bull cases for Europe, which is that this market has seen a lot of buybacks, a lot of shareholder returns, specifically from the financial sector, as you point out. When does that come to an end? If you start to see this idea of tariffs weighing or recessionary impacts or whatever these fiscal deficits and fiscal issues might bring about, a pullback in some of those shareholder returns, what's the canary in the coal mine for that?
So the buyback theme is certainly helpful, and we have more color on that in the U.S. or more information on that just in the last 24 hours. It's a theme we think is likely to persist both in the U.S. and elsewhere, and of course it's the old-fashioned supply-demand type of support structure, and we think that will continue to be a factor for markets as we look ahead. From a debt standpoint, it is a little bit remarkable and impressive how resilient and comfortable global markets have shown with these ever-expanding levels of government debt. UK gilt yields are down notably from where they were just a couple of months ago. The U.S. 10-year yield is also down notably, closer to 4.2, 4.25%. It was about 4.6% amidst all of that uncertainty earlier in the year. So if we get enough growth, it's remarkable how much growth can paper over or cover up a lot of these debt concerns, and that's largely the theme that we're seeing, comfort in the bond market.
Eric, great to see you. Thanks for stopping by to see us. Eric Waitlist, EMEA, Head of Investment Strategy at JP Morgan Private Bank. Let's take a look at those equity markets right now and see what is happening. We'll start with the call, then we'll get what Joe's eye is on this morning. This is the picture, as you can see, broadly bid. Ferrari a little soft this morning. LVMH is quite strong, and in fact the CAC's having a slightly better day broadly with luxury back on the front foot. What else are we watching? Joe Easton's here with the details.
So one stock I'm watching very closely, Guy, is Greggs. Take a look at this one. We're down almost 14% at the open of trading for the UK bakery company. Now, they are saying in a statement that they have been hit by warmer weather, which kind of makes sense. You kind of don't really want a sausage roll and a hot chocolate in this kind of heat that we've had over the past couple of days and weeks, but that is the reason why they're lowering their guidance in an unscheduled statement to the market this morning. Analysts becoming very bearish, seen Shore Capital downgrading the stock and others reducing their estimates for the company. So Greggs, one of these really high-flying UK stocks hit by the warmer weather, potentially actually just some easing in the general consumer sentiment as well, weighing on that one, but a big mover in the UK today. Then in terms of other big UK movers, we've got Bytes Technology down 25%. Now, this is kind of a cloud and cybersecurity firm in the UK, more in the smaller cap space. But the statement from them also weighing on a Softcat as well, a bigger stock on the stock 600 and the broader UK tech space. Taking a bite out of that one. The producer put me up to putting in that pun there, so I had to throw it in. But Bytes Technology down pretty sharply today, 25%, a big loss on that one. Then moving over to the ones that I kind of had a little bit more time to prepare for. The renewables gaining today, including Vestas, after this update from the Senate bill in the US on the big, beautiful bill, stripping out this provision that was going to actually tax projects that were using Chinese components in the renewable space. So Vestas getting 9%, one of the best performers on the stock 600 today. Ørsted gaining as well, Nordex and also EDP, all of the renewable stocks moving higher as expected, given that update on the big beautiful bill. Then in terms of Spanish banks, we've got that deal coming through. Santander buying TSB from Sabadell. Unexpected kind of in terms of both the price and the actual bidder for that, but taken relatively positively at the open. Sabadell coming up 3% at the moment. Santander edging very slightly higher as well. Now, the new enlarged company Santander going to be serving more than 25 million people here in the UK. Then a couple of M&A stories to bring you. Firstly, Avanza over in the Nordic market. Now, this is kind of an investment services firm. There is a report in local media about potentially a takeover, a take-private deal for the firm. This is kind of a version of Hargreaves Lansdown in the UK, but over in Sweden. So that one up sharply. And then finally, we've got a price on the Spectrus takeover by KKR. It's at £4 a share. This one has been going on for some time, so we're seeing the stock actually coming up very slightly, even above that at the moment. This is the UK industrial component firm. Spectrus gets its takeover and rises almost 5% in London this morning.
Joe, thank you very much. Joe Easton from our equities team. Thank you for the update. So quite a lot of movers this morning, including in the Spanish banking sector. Coming up, Santander agrees to buy the UK bank TSB from Spanish rival Sabadell. We will delve into the details of the £2.7 billion deal. That conversation next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
The UK is really important because it helps stabilize our cost of capital, our risk-return profile. We have a low-risk business in the UK is stable returns in a strong currency. So this helps stabilize the volatility of our returns that come in developing economies.
Santander CFO Jose Garcia-Cantera speaking with the show earlier about that deal for TSB. Let's get a little bit more insight on the merits, or maybe not so much merits for it, whatever the opposite of merits is. Bloomberg Managing Editor for Finance and Investing, Tom Metcalf, joining us around the table. Tom, this deal has left all of us, I think, scratching our heads a little bit. This feels like a very expensive deal for very little. What is Santander getting out of this?
Yeah, Santander are certainly paying up. They're paying, way over book value for it, which is quite unusual among UK banking. I think basically, what really they're getting a very big mortgage book, which in their view very low risk, and also, they're looking at it from the group point of view. They have this very strong sort of tech system running through their system that they think will mean they'll be able to integrate TSB quite easily, and then also gives them scale in the UK market. So for me, the biggest thing here is this is Santander coming out, despite rumours they might even have been looking at selling their own UK operations, now, going all in on the UK, and they're now one of the sort of top lenders.
And they clearly see the UK mortgage market, which is what they do a lot of, and will continue to do, as pretty low risk, because they say that this helps their risk profile. It sits alongside what they're doing in emerging markets and helps to balance the risk profile for the business.
Yeah, exactly. And, so they'll go from about 10% of the UK mortgage market to about 12. I think that makes them maybe the fourth largest now. So, yeah, it's definitely a business they're looking to get further into. And as you say, it's one of those that they think, there won't be too many painful provisions or anything like that coming down the line. It's just reliable earnings that sort of evens out that, as you say, in other markets, they're much more volatile.
If you're a shareholder, though, in Santander, is that what you want? Do you want boring? Because that sounds like what we're talking about here. Is that good news for your view of where this business is going? Could this money have been used elsewhere? Could this money have been returned to shareholders? Why are they paying over the odds for this business? There's so many questions around this deal, this transaction. It's so surprising that Santander have made a decision to invest in a market that until recently people were questioning whether they were going to continue to be in. Not putting money to work in higher returning areas of the business and not returning money to shareholders. Do you think shareholders are going to be surprised by this news?
Yeah, well, certainly some analysts are saying, this sort of it looks quite interesting and surprising. But, look, shares are up slightly. I think boring is certainly good, for any company, but particularly for banks where, you just don't want those surprise shocks, say, from like the investment banking side or the capital market side. And yeah, I think basically what it does do is clarify the strategy. So where there might have been some confusion about, won't they sell the UK? Now it's very clear they're not. It's clearly one of their tent poles. And, perhaps with that focus, they can kind of, get the returns they're saying they will. And the idea of, scale in banking. If you're going to be in the UK, get bigger, because what you don't want to be is sort of on the smaller side here.
Well, Tom, there is a lot of speculation, not just from the media, but from the analyst community as well, that ultimately this is something that endangers the BBVA takeover for Sabadell. And my question to you here, and we kind of posed this question to the Santander CFO as well, is that where are we on that consolidation timeline? Is a deal like this making it harder for consolidation, not just in Spain, but in Europe, across the board?
So this is the other fascinating part of this thing, is this whole other thing going on, BBVA trying to buy Sabadell, which has just sold TSB, while it's under offer. So Sabadell have this duty of passivity. So what that really means fundamentally for the TSB deal, they have to go to their own shareholders and make sure they get approved. But they're doing a very good job of pushing this sale. They're saying we're going to do a big, extraordinary dividend, about 2.6 billion will go back to shareholders. So for me, that's the most interesting thing. Can BBVA, as a bidder for Sabadell, actually do anything to disrupt this? Do they want to? I mean, the question is, what would BBVA do if they owned Sabadell? They'd probably want to sell TSB anyway. But obviously, when you're the bidder, you kind of want that control. So that's something we're looking into, is where does this leave BBVA? Can they do anything to intervene? Do they just have to watch? And what does that mean then for a deal where they originally bid, obviously, for Sabadell with TSB?
Yes, and Sabadell saying that the two have nothing to do with each other. They didn't do this because of the BBVA approach. We will look forward to your further reporting on that. Bloomberg's Tom Metcalf then with the latest on the banking sector.
Still plenty of questions to be answered. Let's turn our attention to what is happening in the auto space. Elon Musk has assumed oversight of Tesla's sales in Europe and the United States following the departure of one of his longtime deputies. This as the EV maker's vehicle deliveries are expected to climb for the second consecutive quarter, with sales figures due later today. Let's bring in Bloomberg's global auto editor, Craig Trudell. Is this a good idea? Musk, one of the reasons why sales are down is because of Tesla's association with Musk.
Yeah.
So is he being forced to do this, and is it going to have a positive impact?
It's probably, I may quote Taylor Swift too much, but it's
you can never quote Taylor Swift too much.
I'm the problem, it's me. I think that sort of may apply here, right? Where Musk very much is, if not the biggest culprit for Tesla's weakness in Europe, is up there on the list, right? There was a lot of questioning early this year about just how much is it him versus the fact that they were changing over the Model Y. That is their most important vehicle.
Yep.
That was disrupting production across the world for the country. And so we did need to see sort of sales, play out for a few months to see, with that in the fold, will this company recover? What we've seen here in Europe the last few months is it has not.
No.
And so, Musk has, of course, taken extremely polarizing stances on anything and everything on a day-to-day basis, and that includes here in Europe.
He recently pushed back at that suggestion, though, didn't he? And, we flagged the damage that his political stance seems to do to his sales in Europe, but then he says, but I do better on the right. So, is there any validity to that? What does the overall picture tell us, Craig?
I guess we have to some degree, we have to take him at his word for that. I think, in the U.S. Market, I think, of course, one of the things that he may have an issue with now is he's alienating Trump fans, right, by sort of going after the president in such an emphatic way. That being said, it may be the case that people are willing to overlook that and also may agree with him that it's not such a good idea to add trillions of dollars to the national debt. But in Europe, I think it is absolutely the case that he is still viewed as sort of part of this Trump movement. Trump, of course, is not particularly popular in a lot of major countries in Europe that happen to buy a lot of electric vehicles. And I think it's also just been the case, too, that we've seen this region get a heck of a lot more competitive in the electric vehicle space because of the Chinese competition, and despite tariffs.
And, of course, he commented specifically on European politics as well. So maybe not necessarily to do with his stance in U.S. politics, but the things he said here in Europe. Kriti.
Absolutely. Craig, very quickly, a question here on supply chains. One of the big questions of Tesla during COVID was simply that you build your factories in Berlin or Shanghai closer to the supply chains. Do you think that strategy changes as we're talking about sales declining?
I think there is a real question for me of Tesla has built this massive plant in Germany, had plans to expand it. Do they step back from those plans given the weakness in this market? Do we start to see actually some taking off of shifts, more downtime in that factory? Because right now we just are not seeing the degree of sales there, and that does raise real questions about how much suppliers are really concerned. Because when the company does set up new factories, as is the case with the rest of the industry, they want to localize their supply chain and tap suppliers that are close to that new plant.
Certainly something we're going to keep a very close eye on. Where in Europe can you do that? Craig Trudell, Bloomberg's Global Autos editor, walking us through the Tesla story and how it interacts with Europe. Coming up on the program, we head to the ECB forum in Sintra, where Bank of Portugal Governor Mario Centeno joins our very own Francine Lockwood. That conversation next. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The U.S. federal, fiscal path is not a sustainable one. The level of the debt is sustainable, but the path is not, and we need to address that sooner or later. Sooner is better than later. That's what I said last year. There's not a lot more I can say.
Of course, the Fed chair, Jay Powell, speaking to Bloomberg's Francine Lacroix in Portugal at the ECB Forum. That was yesterday. Today, she's got another great guest. She's joined by him now. Francine, over to you.
Guy, thank you so much. Thank you so much. And good morning from Sintra, Portugal, where we had a good conversation on inflation, tariffs, and actually what comes next. I'm delighted now to be joined by Mário Centeno, Governor of the Bank of Portugal, o Banco de Portugal. Thank you, Governor, for joining us. Look, there's a lot to talk about. It's inflation. It's actually when you see, is there a need for a cut again this year from the ECB?
Well, it's still in the middle of the year, so we have plenty of data to get. We remain cautious and following all possible numbers and evaluation that we have from what's going on. We just got 2% inflation in June. That's precisely on target, so this is very good news for us. The economy in the first quarter also showed strengths in Europe. We need to see if it keeps that profile over the course of the year. That will be great news for us. I'm worried, if I may say it like that, with investment, because we need a pickup in investment in Europe to sustain precisely these growth rates that we want to achieve.
So, Governor, are you worried that you're not getting enough investment? Do you have the numbers that make you worry, or is this a worry in absolute because of the tariffs?
I mean, it's the profile for investment in the euro area is, of course, impacted by the cycle of monetary policy rates. So it's actually the variable that responds more forceful to an hiking interest rate. So it's understandable in that sense, but it's taking too long for it to recover. So of course, uncertainty doesn't help either. So, and we have been plagued with sources of uncertainty that also deter investment. So we need to move away from these, give certainty to investors. Trade deals will be great, but that's to the European Commission to discuss. And if something on that vein occurs, I think we will make it.
Governor, I mean, inflation is also very much impacted by currency. We spoke to Vice President de Guindos yesterday. He was saying, look, 120 for euro is problematic. Do you agree?
Well, I think it's we need to think about the exchange rate as a market outcome, and markets adjust if there is some development that it's not sustainable. I'm sure that will show up in the numbers. We need to think about the current number, the current perspectives for exchange rate as reflecting the strength of the euro, what's going on globally. We are also pushing a lot to increase the international role of the euro. That, of course, will bring more investors to Europe, will increase the interest in the euro. So that's good.
Governor, how do you think about interest rate cuts? Again, given where we think we are in the neutral rate, if you cut further, then it will become actually stimulative. I mean, should that be a concern given all of the uncertainties, the oil price, inflation, tariffs, and trade?
There's a range of estimates for the neutral. And neutral means that everything else is also in equilibrium, if I may say. This is kind of too technical, but it means that we are at our potential in terms of growth, that the labor market is also in equilibrium. We are not there yet in terms of growth. So for the system, for everything to be in equilibrium, then the neutral for interest rates would be an important concept. And we have an history in Europe of very low inflation.
Right.
And I did see the fundamentals for that to be changed as much as we can comfortably only sit at neutral. But this doesn't mean that we need to rush into that. We need to see data. We need to look at what are the developments. The second quarter figure for GDP will be very important because if it confirms the first quarter number, that is a story. If we go again to tumble a bit in terms of growth, that will raise concerns, in my view, about how sustainable will the 2% inflation be.
Governor, should we worry about the inflation numbers going down significantly?
That is precisely my point.
But you're worried about them going down more than going up?
Yes. That's actually also the profile for inflation in our forecast. Yeah. We will begin 26 with a low number. There are base effects on that, but it's also the recent history of Europe. It's not one of high inflation, high pressure on that. So we need to be cautious about it.
Governor, do you believe that actually the euro can play a much bigger role in this, challenged global dollar reserve currency like Christine Lagarde wants euro to play?
That's a long-term project that we actually start talking about it 5, 6, 7 years ago. It's natural to happen as the institutional environment of the euro strengthens, and it has been that the case for already 10 years, that Europe plays a more compatible role in the world with its history, with its reach to the global economy. So I think it really is important for us to work towards that goal, and we have been doing that. We have been strengthening the institutions in Europe. Also fiscally, we have been taking decisions that are really bold in terms of creating a union that is also fiscally more stronger and working together. So that's good.
Governor, when you look at the trade negotiations, right? I mean, it'll all come to a crunch in the next couple of days. Does it alter the path basically for the economy in Europe? And so ultimately, does it also decide whether the euro can become a global reserve currency?
It will have a big impact in reducing uncertainty. That's having a deal there gives clarity to consumers, to investors, to firms, to producers. So that's the main goal of it. It was nothing that we were asking for to happen, but once we have to engage on that, so the best thing is to settle a deal and tell people, look, this is what we have to work
Will that happen? Do you think we'll have some kind of deal, or does it get pushed back?
I think it's important to have a deal. I mean, I'm not involved in the negotiations, so I'm not going to comment on that, neither put pressure on those that are at the table, because those are not easy negotiations anyway. But it is really important to reach a deal and to send that message. Look, this is what we have with us, so let's work with it. If it's important for the continuation of this process of Europe gaining more relevance internationally, I'm sure it is. Europe is a very, very open economy. It's actually the openest economy in the great economies, in the largest economies in the world. So more than China, more than the US, we developed ourselves in this global economy, and we don't want it to go back.
But Governor, very quickly, I mean, does it impact, again, what we know so far of the tariffs? And I know there's a delay in actually, some of the concern, I guess, being filtered in the data. Is it bad for growth, inflation? Like, what are the second round effects?
It certainly is bad for growth because it's a tax. And we know what taxes do to economies. I mean, we will have a smaller economy after tariffs than we used to have. So that's almost clear for everyone on the table. And for prices, it depends on the degree of retaliation that Europe has. It can be deflationary for Europe.
Governor, very quickly, your term is coming to an end very shortly. Will you serve a second term?
That's a decision that someone else has to take. I mean, I'm comfortable in my position, so let's see.
Okay, but if they offer, you'd take it?
Yes.
Okay, thank you so much, Governor, for your time today. That was, of course, Mario Centeno, the Governor of the Bank of Portugal. With that, I'm going to send it back to you in London.
Bloomberg's Francine Lockwood there. We thank you so much. Of course, having a conversation with none other than Mario Centeno. We have more interviews from Sintra today, including a conversation with the Bank of England MPC member, Alan Taylor.
Gotta hope the wind dies down. Great windsurfing on the west coast of Portugal. Coming up, talking about maybe an ill wind. This time, the UK Prime Minister, Keir Starmer, abandoning his welfare reforms, leaving a potential £5 billion hole in the government's finances. We'll break down the implications next. This is Bloomberg.
this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The level of household and corporate debt in the UK economy is actually lower than we would have expected it to be, but based on past experience. So again, that feeds through into just how restrictive policy is at a given interest rate. It's somewhat less restrictive probably than it would have been historically.
Bank of England Governor Andrew Bailey there, speaking at the ECB's forum on central banking in Sintra, Portugal, of course, accompanied by many other voices from the world of central banking. But it was really interesting what he had to say there about high interest rates not having the impact that they would previously have had in the UK because of lower debt levels amongst individuals and companies, crucially not governments.
So that's the problem the UK faces right now, is that individual companies don't have a lot of debt, so their buckets are relatively full. The government bucket is empty. How do you fill the government buckets?
Yeah,
tax rises,
potentially. Takes us on to our next topic, or what happened yesterday, specifically. Let's stay with the UK now, where Keir Starmer dramatically abandoned his flagship welfare reforms to avoid a major parliamentary defeat. The move leaves the UK Prime Minister's authority badly damaged and his government facing a widening fiscal hole.
Our plans will create a fairer society, one where people who can work get the help they need, where we protect those who cannot.
This is a rushed attempt to plug the Chancellor's fiscal hole. It is driven not by principle, but by panic.
Just a flavour of the drama in the House yesterday. Let us bring into the conversation Bloomberg's Ruth David and Bloomberg opinion columnist Rosa Prince. Very good to have you both around the desk with us to help us establish what happened yesterday, where we are nearly a year into the Starmer administration. I mean, I guess we get quite immune to hectic scenes in the House of Commons, don't we, Ruth? But this was a real climb down by the government. Keir Starmer had to really strip out the guts of this bill to allow some of it to pass.
Absolutely. And the Conservative Party, one of the spokespeople said, this government has lost its economic credibility, which is damning words coming from an opposition party that went through the Liz Truss regime. I mean, today the markets have been muted, so they haven't responded that dramatically. But the question is, if they have lost their economic and fiscal credibility, where do they get the money that's needed? They gave away $5 billion yesterday, right? And that's on top of what they had given away with the winter fuel cuts for pensioners that they rolled back on. But there is also a sense that if this government takes any decision that is fiscally prudent or that requires slightly tougher measures and there's opposition, they're going to backtrack. And, you know, what is that step between being a leader who listens to your party and being a leader who's seen as weak?
Yes, how you make difficult decisions, how you get the party to come along with you at a time when there are no easy choices, I suppose, is part of this.
Yeah, we're coming up on 1 year. I think the second year is going to be quite interesting. I think the challenges are going to get greater in the second year, not easier from the first year. So, Rosa, what do they do next? Are taxes going up? The question everybody's asking themselves this morning is, how high are taxes going to have to go? Which taxes? Are they going to have to pull some of the big levers, income tax, dare I say it, and some of the things they promised they wouldn't do?
Yeah, well, Pat McFadden, who's kind of the government's sort of attack dog, big defender of Keir Starmer, he had said this morning on the morning round that they would stick to their manifesto commitments on tax. Now, if you remember, there were these slightly weasel words where they said they wouldn't raise tax on working people, which has been taken to mean income tax, possibly VAT, national insurance. That doesn't leave them with very much. And I think what they seem to be doing is boxing themselves in again, which has been the problem of this whole year, where they say, we're not going to do that, we're not going to do that. And then in the end, exactly, what are you going to do?
I mean, it's interesting. The opposition party will say they've lost fiscal credibility. We remember the Liz Truss days, and of course others will. There'll be plenty of views about when or not fiscal credibility is lost. The government would still say they cling to their fiscal rules. At least we think they do, unless they change some of those when the next budget comes around. But the market, as you say, Ruth, is pretty calm. I mean, does that tell us anything about the market's judgment, or is the market just focused on other things? The market is thinking about the US budget, and the market is thinking about a strong euro. It's thinking about a whole host of other things that aren't necessarily domestic.
I think there is definitely the latter. The market is focused on a lot of other things, and it has not been... this reversal hasn't had so much of an immediate big bang effect that the market should be taking into consideration, right? You're saying, well, okay, let's move it along to the budget in the fall and see what that brings. And maybe she'll find a way to increase borrowing, which I know she said she wouldn't do, but the tone of the government on that is changing.
Wouldn't do. So does this imply, this is the question that everybody's now asking themselves as well, is she the right person for the job?
Absolutely.
In order to make the changes that are going to be necessary,
yes,
are we going to have to see a new Chancellor? And will Number 10 also maybe take greater control over the levers of power at the Treasury? Because the Treasury feels like it's pulled a lot of strings, a lot of levers over the last 12 months. Does Starmer need to get a grip on all of that? And is a new Chancellor required to get that grip?
I think that question on whose head rolls after all of this is definitely being asked, right? Liz Kendall was asked it on the BBC this morning whether her position was still tenable, and she said they made the right call by listening to dissenters. But while everybody was focused on the vote of the welfare, there was another big bit of news that AstraZeneca might be looking at moving its listing to the US.
Yeah.
Now that's important because in terms of UK national champions, it doesn't get bigger than that. And if they are saying we want to move our listing out, despite all that this government has been saying they'll do on the financial markets, that is a definite vote of no confidence, right? And the fact that they haven't said anything to that story yet is not a great sign. It just adds to the ticker of bad news for the government this week.
Well, Rosa, weigh in on that a little bit, because I feel like the UK hasn't fully recovered from the arm listing going to New York. How brutal would an AstraZeneca loss be?
Oh, absolutely. I mean, what a blow. They're trying to talk up the UK and saying it's a great place to invest, it's a great place to run a business. And then something like that just says more than 1,000 comments from ministers. I personally don't think that Keir Starmer can afford, actually, to sort of throw away Rachel Reeves' career, because I think he's so tightly bound up with her. I mean, particularly in the run-up to the election, they really came as a double act, and I think it would be a self-inflicted blow if he tried to blame this mess on her. I think the two big things she has done wrong were the initial decision to try to withdraw the winter fuel benefit, which just came out of the blue, kind of set the tone for the whole government, and then these cuts to disabled benefits, which again didn't really have much thought behind them. They were really just to save some money rather than to have a sort of whole body of work of welfare reform, which I think her Labour MPs thought was necessary. So Labour MPs are angry with Rachel Reeves. I don't think Keir Starmer will cut her loose. I just think that would rebound and look bad on her. I think maybe there will be figures inside Number 10 who will be worrying about their jobs, though, today.
Okay, so there could be other heads that roll. Now, we are nearly a year in. You mentioned the winter fuel debacle, and it did seem as if something... I mean, this was £1 billion, more than £1 billion, but that's not enormous on a global stage at all, and yet it stayed in the news headlines in the UK for such a long time. So many things to learn on communication. As we approach 1 year of the Starmer administration, what else do they need to learn? Do they also need to learn that the Prime Minister maybe, sure, do well on the global stage, but also stay engaged at home?
Yeah, definitely. I mean, Keir Starmer's explanation at the weekend, he gave a series of interviews to mark his anniversary, was, oh, I was a bit distracted by what was going on the world stage. He had been at a NATO summit, he'd been at the G7. It's not really good enough. I mean, one of the things you have to be able to do as a Prime Minister is to be able to juggle. Multitasking is the name of the game. It's kind of why the role of Prime Minister was invented, why we don't just have individual departments running different sections of the state. We need somebody kind of bringing it all together. So I think that's something he's going to have to do. I think he's very brutally learned that he has to have better relations with his own MPs, because at the moment they're really running fiscal policy, which is not a good place to be in. There are some MPs who complain they've never met him, which is an extraordinary position. I know he's got a lot of MPs, but who have not met Keir Starmer. There are Labour MPs who have never met the Prime Minister. That's going to change. I think there will be some invitations into number 10. So that's another thing. And I think just generally, his communication is not very good as an operation. They don't seem to keep the public along with what they're thinking and doing.
That sounds like British understatement. Guys, we're going to leave it there. Thank you very much indeed. Bloomberg's London Bureau Chief, Ruth David, and Bloomberg Opinion columnist, Rosa Prince. Let's talk about what we are seeing with the gilt market right now and just figure out whether or not it stands out from other markets around the world. And I think the answer this morning probably, as we've already alluded to, is it probably doesn't. We are seeing bond markets selling off, but the UK doesn't stand out particularly, Chrissy, in that regard.
No, it doesn't, but the currency kind of does. When you look at the pound here, for example, you are looking still at a 137 handle. I think the more exciting rally that we're seeing at the moment is in euro dollar, and it kind of briefly hit that 118 handle, retraced. Now we're at a 117 handle. Bloomberg's Valerie Teitel is going to walk us through it. How excited should we be about this euro winning streak?
Well, it's the longest winning streak in 20 years for euro dollar. And, you know, yesterday it breached a new high for the year at 118.20. So there is a breakout currently happening in FX. It's pausing a bit this morning. But this dollar move is really rattling not just currencies in Europe. Also look at currencies in Asia, even the Taiwanese dollar breaching new levels this morning. And dollar Swiss as well. We got to talk about that one. That hit at a new low that it's not seen since 2015. We do have some Swiss CPI data tomorrow morning. There is a speculation if there's a big miss to the downside, if there's a deflationary print, I mean, you could see the S&B do an extraordinary cut, and that's the kind of scenario.
2-year yields, are you thinking about the United States? I know you wanted to mention the short ends of the curve. I was really interested that the JOLTS number seemed to capture the market's attention. I guess that goes to what Eric White-Ennis was telling us earlier. It's all about jobs data. Any cracks in the jobs data, and it's harder for Powell to wait and see.
Yeah, no, I thought it was an outsized reaction to the JOLTS data, especially when you have to remember the JOLTS data is 1 month delayed. That was data for May. The ADP today and NFP on Friday is going to be data for June. So, you know, I guess eyes looking forward, obviously Friday's print means a lot more in terms of where to next for the labor market. You know, you're getting a lot of questions on what kind of print would turn around this dollar weakness. And frankly, I don't think there is a print that would turn around dollar weakness. On a strong print, the market's just going to shrug it off, saying that, oh, labor market weakness hasn't hit yet. It's going to hit at the end of the summer. Powell's talked a lot about that, especially when it comes to the inflation impact from tariffs as well. On a weak print, you know, we're going to price in more of a Fed cut in July. Market's currently pricing at around 20%. If we get a weak enough print to move that substantially higher, I mean, that opens up another wave of dollar weakness as we continue to think about where, you know, where the Fed could cut to by the end of the year if the labor market deteriorates significantly.
The number's been creeping down all week. The whisper number's currently 100K, survey number's 110.
Anna Wong is 120, and she's the, you know, our Bloomberg economist. She always hits it on the nail. So she is going for a slightly hotter print than consensus.
Okay, there you go. It will be tomorrow, not Friday. Tomorrow,
a day
we will
early.
be doing this. The holiday in the United States causing that. Anyway, that wraps things up for this show. The opening trade. The Pulse is up next. Anna will be taking you through that along with Francine Lacroix. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, the ECB Forum on Central Banking here in Sintra, Portugal, and these are your top stories. President Trump says his July 9th global tariff deadline will not be extended as he ramps up criticism of Tokyo. Here in Sintra, the Fed chair says rates are on hold because of U.S. tariffs, but he doesn't rule out a cut in July.
We went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariff.
Plus, Trump's multi-trillion-dollar tax bill faces resistance in the House ahead of a vote later after narrowly passing the Senate. Now, President Trump's tariffs have been a major talking point here at the European Central Bank's annual conference. Trump has said he's sticking with his July 9th trade deal deadline while renewing his threat to cut off talks and slap duties on various nations, including Japan. Now, the world's most important central bankers discussed the impact when they took the stage during a panel I hosted yesterday here in Sintra. Now, the Fed Chair, Jay Powell, repeated that the U.S. Central Bank probably would have cut rates further this year if it weren't for Trump's expanded use of tariffs.
In effect, we went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time. As long as the U.S. economy is in solid shape, we think the prudent thing to do is to wait and learn more and see what those effects might be. And again, they haven't really shown up. So for now, we're waiting.
Now, also weighing on U.S. policymakers is President Trump's multi-trillion-dollar tax bill. Well, it's squeaked through the Senate on Vice President J.D. Vance's tie-breaking vote. But it's now running into Republican resistance in the House as moderate and ultra-conservative lawmakers threaten to defy the president and sink his domestic agenda. Now, as the bill continues to divide opinion, here in Sintra, the Fed chair also repeated a warning over Washington's debt path.
The U.S. federal, fiscal path is not a sustainable one. The level of the debt is sustainable, but the path is not, and we need to address that sooner or later. Sooner is better than later. That's what I said last year. There's not a lot more I can say.
Well, the Fed Chair Jay Powell speaking here at Sintra yesterday. Now we'll hear from some of the other leading central bankers who are on that panel a little bit later. Now, ECB Vice President Luis de Guindos told us yesterday that an advance in the euro beyond 120 could prove tricky for policymakers. He says current levels are not cause for concern.
The level is not the problem. I think that this is perfectly, acceptable according to our projections. Here the question is, that we should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, is not something that we cannot we can overlook a little bit. Something beyond that, it will be much more complicated. But 120, I think that is perfectly acceptable.
Certainly, the euro's fortune have been a hot topic of discussion here at Sintra, but also beyond the forum. Now let's head over to Anna Edwards, who's in London with a very special guest. Hi, Anna.
Good morning to you, Francine. Yes, absolutely. Back here in London, Stefan Hoops joins us, the CEO of the asset management firm DWS Group. Stefan, very nice to speak to you. Thank you for joining us here in London. As Francine was just setting out, the strength of the euro, quite a talking point at the ECB conference there in Portugal. And I wonder how that is factoring into investor conversations, client conversations that you're having. The strength of the euro at 117.76 against the dollar, not over 120, which Luis de Guindos said would worry him, but strengthening it seemingly all the time.
Well, I mean, certainly the speed this year has been strong, very fast. So, I mean, it strengthened 14 cents versus the dollar just year to date, and that's significant. I think the discussions are really twofold. To some extent, it obviously has an impact on company revenues, right? I mean, for the euro to strengthen, it makes European products more expensive across the globe. So that will have at some point impact on the underlying profitability of European companies. But at the same time, obviously, investors across the globe, they look at the strengthening of the euro, and it comes on top of strengthening of the DAX, for example, of stocks, right? So therefore, it's really twofold. To some extent, underlying profitability is probably going to take a hit at some point, but at the same time, euro assets remain incredibly attractive.
Yes, and Francine was talking to Mario Centino earlier on, who was suggesting that the strength of the euro is perhaps driving more investment into Europe, attracting more investors into Europe as they worry about where the dollar's going to go. Do you see that? Is that what client conversations look like to you, Stefan?
So for sure, so just think about stocks in dollar terms, right? So the S&P 500 went up 5% for 6 months of the year. The DAX went up 20, and on top you have the 14 cents of euro appreciation. So if you're a U.S. investor and you bought the DAX, you're up 35% in dollar terms year to date, and that's obviously significant. Now, what we have seen so far is that institutional investors are quite interested in European assets, right? So there's definitely a reallocation, probably away from the dollar, not overnight, but long-term over time, and towards Europe. For retail investors, U.S. investors, they continue to just buy U.S. stocks, so that's, I guess, what they know and what they like. But we've seen a significant repatriation of European retail money back from the U.S. into European stocks.
Okay, that's interesting. And does that make it a good time to look into stable coins that are perhaps pegged to the euro and not to the dollar? And I think you have some news about that this morning.
Well, we do. Thank you very much for bringing it up. So we actually just announced that our JV that we formed with Galaxy Digital and Allunity, its name, that we formed with Galaxy Digital and Flow Traders, we got the BaFin license yesterday to issue the first euro stablecoin out of Germany. Right? And we feel that stablecoins, when you think about the many use cases that it has, not today, but probably way more in the future, it's quite significant. Right?
Yeah. Does euro strength and dollar weakness, is that playing into the timing of this? Does that make it a good time to launch this kind of product?
I would have a more longer-term perspective, right? So you've had dollar stablecoins for some time, and Circle just IPO'd, and I guess that IPO shows that there's tremendous interest in stablecoins. But so far, we didn't have a digital euro, right? The ECB will probably, they're working on it, but that will take a few more years. So we definitely need to bridge into a digital euro. And, we will, as Allunity, will be the first properly regulated euro stablecoin out of Germany. So we feel that is significant.
Yeah, and what gap is that trying to fill, that kind of product? What's the gap that needs filling with this?
Important question, right? So what are the use cases? I mean, today, it's really mostly people moving from fiat to get their currency on-chain to then buy crypto, right? To some extent, you simply need to get your dollar, your euro, whatever, on-chain, then you can buy Bitcoin or whatever you want to do. I think over time there's going to be way more use cases. So retail payments. So at some point, are we going to use wallet-to-wallet stablecoin payments in order to buy, pay for a cab or buy a beer at night? And I think once it actually goes to corporate payments, where again, like being able to do 24/7 fractional payments, I think it's going to be one of those use cases for the years to come.
Let me ask you about one theme that in Europe has been quite dominant so far this year, and certainly driven by a lot of the news flow out of Germany. And investment in the defence sector seems to have become a real hot topic that a lot of investors want to talk to us about, and so CEOs are thinking about whether their businesses are offering those opportunities. So how is DWS thinking about the increase in defence spending we're going to see in Europe, and what role you play in that?
So firstly, this is going to be an irreversible trend. So the EU, or European countries, are clearly committing to spend a lot more on defense. So this train has left the station, this is going to come. So you'll have significant investments and a lot more of that going into European companies because of the idea that we should procure locally. Now, when you think about who can buy defense stocks, so far there was a self-imposed cap on not buying defense stocks for pretty much any fund. Now, what we're going to see going forward is that ESG funds will continue to not include defense. However, funds which are not ESG, they so far were restricted because of that self-imposed restriction, but going forward, they will invest in defense stocks.
And is that what DWS's funds will look like? So anything that's ESG labeled that won't have defense in there, but things that are not, there will be more investing in defense? Or has that started already?
It has started. It took some time because you sort of had to, without going into too much detail, but there was, this restriction that had to be lifted, prospectuses had to be changed. And then about a month ago, we gave green light to our PMs for the non-ESG funds to be able to invest in it. Now, I think one important question is, what about all of those non-publicly traded companies? So you see the big companies, the Rheinmetall and so on, but you have about 400 mid-cap companies that are essentially the defense supply chain. And obviously, as the number of orders for the big companies go up, all of the smaller non-publicly traded companies also need to increase capacity. Yeah. So when you think about impact for private credit, for example, there will be a lot of private credit for those non-publicly traded defense companies, and that's also something which DWS is very focused on.
Yes, what kind of role do you think DWS wants to play then in the private credit space to fund that medium size and smaller size business in the defense space?
So this is where our collaboration with Deutsche Bank really comes in. So Deutsche Bank, across its investment bank and corporate bank, they have access, they cater, they bank, they finance all of those companies. So therefore, that access is something which we would like to, through our partnership with Deutsche Bank, then make accessible and investable for our global investors.
What kind of businesses are we talking about here then, Stefan? What are the types of businesses that private credit might be the answer for?
Arguably anyone who is not publicly traded and needs to materially either invest in any sort of, disruption-led, trend, or simply needs to increase capacity. And if you're not publicly traded, you don't have access to, capital markets. You can just, you could IPO, but it's lengthy. It takes a lot of time. And for those companies to get growth capital from somebody like a Deutsche Bank, and then, we are the ones essentially providing that funding through our global investor base, that's one of those things.
Are there still any questions about which types of companies can be funded? For example, those that make nuclear weapons. Are these still open questions for European investors, for people such as yourselves, or has this been settled? You talked about rewording in prospectuses, for example.
So there's clear definitions of what you would not fund, right? So there are a variety of, without going into too much detail, on all the horrible weapons that clearly you wouldn't want to be any part of. However, overall defense is something which is critical for sovereigns, for countries, and therefore, kind of like the big, let's say, typically defense companies, that is definitely going to be in focus.
Okay, Stefan, thank you very much. Thank you for joining us. Good to see you on the program this morning. Stefan Hoops, the CEO of DWS Group. Francine, back to you in Sintra.
Yeah. So interesting, Anna. Thank you so much. Really interesting conversation with the DWS Chief Executive. Coming up, we'll have plenty more from Sintra. We'll be speaking to Isabel Mateos-Ilago from BNP Paribas on her key takeaways from the central banker discussions here in Sintra. That's next, and this is Bloomberg.
your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Well, the ECB's Sintra Forum underscored a shared preference for patience due to continued uncertainty, but also revealed a growing divergence in the path forward for 5 of the world's major central banks. Now, for most of them, additional interest rate cuts are probably coming this year as the impact of U.S. tariffs becomes clearer, while the Bank of Japan is moving in the opposite direction. Its timing, of course, also clouded by trade policy. Well, I asked them what impact tariffs were having.
We faced a massive amount of shocks, compounded shocks occasionally, and we are now through that disinflationary process that we have conducted over the last 2 years. And yes, we are facing a lot of uncertainty. Yes, we are facing the risk of fragmentation increasing. And yes, we are facing geopolitical developments that are worrying generally, but that also are causing two-side risk to inflation. So we have to continue to be extremely vigilant. We have to continue to be committed to delivering on our target. And I think we are at this point in time in a very good position to do that. So we are well equipped to navigate the tormented waters that we should anticipate.
What can central banks in your position do to shield economies from the impact of trade tariffs?
Actually, about the tariffs' impact on inflation, our current inflation is well stabilized around 2%, and we believe tariff tends to be deflationary rather than inflationary for 3 reasons. One is Korea is not likely to use retaliatory tariff. Second, we import 22% of our import from China, and recently export price of China has been falling at 5% a year for several years, and we believe that it will continue to do so. And at this moment, our growth rate is 0.8%, which is well below our potential growth rate. So aggregate demand pressure is much lower. So our problem is not the inflation itself, but the gross impact of tariff.
It's probably, Jay was saying, I think it's a bit too soon, I think, really to see the price effects coming through from the trade and tariffs action. We've made a point of saying also that, I think as Christine was saying, that these are two-sided. They could go either way. Could be weaker demand. We could see some supply chain disruption. And the second thing, of course, is that some of these effects, if you take the oil price story, it's gone up, it's come down, all since our last meeting, effectively. So, we always reach for the lexicon at this point. We've added unpredictability to uncertainty.
What do you see as the fundamental changes in your economy that make inflation more persistent?
So let me say, to put it simply, as you say, headline inflation has been above 2% for almost 3 years, while what we call underlying inflation is still somewhat below 2%. That's the situation we are in. But if I could decompose it further, there's probably about 3 components to it. First, there's underlying inflation dictated by wage price dynamics, whereby increases in prices affect wages, which further affect prices, helped by resilient domestic demand. This component has been going up slowly, but as I said, it's still somewhat below 2%. Then there's going to be perhaps a second component, which will be the expected negative effects of possible tariffs on the economy and on prices. We think the first component and the second component will produce a slow increase in underlying inflation toward 2% by end 26 or 27.
Some of the world's leading central bankers speaking to us yesterday. Now, for more on all of this, we're joined by Isabel Montero-Zilago, Chief Economist at BNP Paribas. Isabel, thank you so much for joining us. Look, yesterday was, a very interesting panel because over an hour you kind of really understood the differences and the fact that it's just the world is much more uncertain than we thought. Do you see a real divergence in how central banks will play this?
Good morning, Francine, and thanks for having me. And you did a beautiful job, obviously, getting interesting answers out of these leading central bankers. So, yes, I think what struck me was, at most of them are on a very good path to delivering on their mandate, to reaching their targets. Obviously, the ECB is already has landed on 2%. The others are not quite where they want to be. But you would have thought there would be much more self-congratulatory in a way, and they were not. They were not. They expressed confidence that they were on the right track, but indeed the mood was more concerned about this kind of veil of uncertainty and downside risks mostly that all of them saw on the horizon.
So maybe let's take each central bank, one by one. If you look at the ECB yesterday, look, they touched that 2% inflation target. Mm-hmm. This was also helped by euro. At what point does euro actually become a problem for the European Central Bank?
The euro has been featuring in a lot of the conversations, including off panels. Honestly, I think one shouldn't have too much recency bias here. 120, and we're not even there, is not a particularly high level for the euro if you look at the entirety of its history. So, okay, it's appreciated meaningfully against the dollar since the start of the year, more or less 10%. But actually, most currencies in the world have appreciated against the dollar. And so if you look at the real effective rate, actually hasn't moved that much. So obviously, if we were to see much larger moves from here, at some point it will become a problem. But I don't think we're in that zone yet.
I mean, the Vice President yesterday, De Guindos, told us that actually 120 could be problematic. Was he overstating it? Is there a risk that the market tries to test it now?
There's always a risk that when you give the market a target that it tries to test it. But I don't think there's any particular magic value to 120. I mean, people like to set round targets. If you look at, our published forecast for the year end, it is also 120, but there's nothing particularly magical about it. And I haven't seen or heard any particular research saying 120 is, if you go above that, it's a problem. In fact, I think the historical average, long-term historical average is above 120. So I don't think it's an issue.
It's about what are you expecting for the ECB to do? One cut?
Yeah, we're expecting one cut. Obviously not in July, but by the end of the year. I think it's noteworthy, obviously, that despite inflation being back at 2%, President Lagarde explicitly said, "I'm not declaring mission accomplished." So I think there's a signal there. And when you look at the balance of risks over the next 3 to 6 months, I think they are clearly on the downside, and that's what you hear as well. Obviously, the ECB's own forecast has inflation in 2026 being well below 2%, being at 1.6, which probably means it's going to be lower than that even for a few months. And so the risks to activity, the risks from the exchange rate side, commodity prices side are really primarily on the downside. So I think one cut makes sense, but the timing of that we have to see.
Isabel, I have to say, I thought Jay Powell, he doesn't have an easy job because of the personal attacks from President Trump, but also just the fact that the economy, he was really much in a wait and see. Like, let's see if the inflation changes because of the tariffs, and otherwise they'll readjust. Like, what did you find him?
I thought he was incredibly delivering a message of a steady hand exactly where you need it, and extremely focused on, giving a message that, doesn't make him hostage to any kind of political interpretation. But also, and the contrast with Andrew Bailey there was quite interesting. Andrew Bailey had no problem in saying the direction of travel is clearly, cuts. Jay Powell didn't say that. Jay Powell said, there are many paths possible from here, and I'm not ruling anything in or out. Which was, of course, appropriate given the circumstances of the U.S. economy. But it was more than a nuance, I think, between these two central banks, which still have very elevated interest rates.
Isabel, we heard actually from President Lagarde yesterday saying she would do the same as Jay Powell. Here she is.
I think I speak for myself, but I speak for all colleagues on the panel. I think we would do exactly the same thing as our colleague Jay Powell does. The same thing. Yeah. Right?
Yes.
I mean, there was a sense of like the central bankers actually rallying around Jay Powell, right? To I don't know whether it was to give him courage, but again, there's a lot of unknowns in the U.S. economy and a lot of shocks that kind of make sense for him to look at scenarios rather than maybe give guidance forward.
Yeah, that's right. I mean, so it's not just, I think, the central bankers rallying around Jay Powell. It's everybody who cares about central bank independence who feels for him every time there's an attack and admires his professionalism and his steeliness in staying focused on doing the job, which I think is what we heard, and what the public needs from central banks really is not get caught up in politics, but deliver on their mandates. And I think they're all doing that very well. But obviously, Jay Powell faces the toughest circumstances.
Isabel, do you see actually some of the inflation concerns materialize in data? Is it normal that it's taking this long?
It has surprised us that it's taken this long to show up in the data, but we have pretty strong conviction that it's going to start showing up through the summer months. It's not, if you think about it, it's not all that surprising given the continued uncertainty about what's going to be the final level of tariffs, that companies would be a little careful in changing prices. Also, we know they had accumulated a lot of inventory, so they're running through that inventory now, so they didn't really need to push up prices, preemptively. There's every reason to expect prices to show up in the coming months. But even then, even as they do, you will still have a debate between reasonable people, including on the FOMC, between those saying, well, don't worry, it will be a one-off effect and we can look through it, and others who will be more worried that it could be longer lasting. And I think the state of the labor market will be key in making the judgment whether it's okay to ease monetary policy a little bit, or indeed if it's necessary to ease monetary policy if really the labor market shows signs of excessive weakness, or whether, on the other hand, the second round effects is a real danger and monetary policy needs to stay restrictive.
Isabel, thank you so much, as always, for joining us. That was Isabel Mateos Hilago, Chief Economist at BNP Paribas. We'll have to get you back on to talk about the Bank of Japan. There is a little bit of concern about the wind here in Sintra, but we're fine. We're in a veranda. It is sloshing around. It's not a hurricane. It feels like it, but we're fine. Coming up, Holger Schmieding, the Chief Economist of Berenberg, join us to talk about, he's talking to us about your area's economic outlook, but also trade uncertainty. That's next, and this is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this?
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Forum in Central Portugal, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in Sintra in Portugal at the ECB Forum on Central Banking. Now, these are your top stories. President Trump says his July 9th global tariff deadline will not be extended as he ramps up criticism of Tokyo. Here in Sintra, the Fed chair says rates are on hold because of U.S. tariffs, but he does not rule out a cut in July. Plus, Trump's multi-trillion-dollar tax bill faces resistance in the House ahead of a vote later after narrowly passing the Senate. Now, the European Central Bank is in no hurry to reduce interest rates further following 8 cuts in the space of a year. That's the view of the Governing Council member, Mario Centeno. Now, he also told me weak growth is a real concern.
Neutral means that everything else is also in equilibrium, if I may say. This is kind of too technical, but it means that we are at our potential in terms of growth, that the labor market is also in equilibrium. We are not there yet in terms of growth. So for the system, for everything to be in equilibrium, then the neutral for interest rates would be an important concept. And we have an history in Europe of very low inflation. Right. And I did see the fundamentals for that to be changed as much as we can comfortably only sit at neutral. But this doesn't mean that we need to rush into that. We need to see data. We need to look at what are the developments. The second quarter figure for GDP will be very important because if it confirms the first quarter number, that is a story. If we go again to tumble a bit in terms of growth, that will raise concerns, in my view, about how sustainable will the 2% inflation be.
Governor, should we worry about the inflation numbers going down significantly?
That is precisely my point.
But you're worried about them going down more than going up?
Yes. That's actually also the profile for inflation in our forecast. Yeah. We will begin 26 with a low number. There are base effects on that, but it's also the recent history of Europe. It's not one of high inflation, high pressure on that. So we need to be cautious about it.
Well, that was Mario Centeno, the governor of the Banco de Portugal. Now, euro area inflation rose in June to hit the European Central Bank's target. However, President Christine Lagarde stopped short of calling it mission accomplished.
We are at 2%. And this is the latest reading. This is also the target that we have had, and this is the projection that our staff is indicating for the medium term, which is exactly what we had anticipated. So I'm not saying mission accomplished, but I say target reached.
Well, Lagarde was, of course, speaking on a panel of central bank chiefs here in Sintra. Joining us now, Holger Schmieding, chief economist at Berenberg. Holger, good to speak to you. Is it mission accomplished for the ECB?
Well, it's not mission accomplished. It's, of course, for once we are at target, we'll probably be close to the target for the next roughly 12 months. But the ECB will face two tough challenges. First of all, how to react to the tariff tensions now, knowing that whatever the ECB does now to monetary policy will have its major effect, say, 12 to 15 months from now. Monetary policy works with a lag. And the second challenge is to figure out what's going to happen to the labor market. We know demographics. We know we will have labor shortages in the future. Does that mean that rates in the future actually have to be higher to combat wage pressures, which at the moment are low, but will likely pick up 1 or 2 years from now again? So that might be an argument for the ECB to say, if they're clever, don't cut rates too much now, otherwise we might have to hike them in 2027.
But Holger, so are you expecting a cut actually from the ECB this year? And how much of a worry is the euro level?
I don't really expect an ECB rate cut this year. I do assume that Trump and the tariff threats, that he will not follow through on the worst of it, that his bite will actually be less bad than the bark. We are now once again in the bark period, him putting pressure on everybody to get something done by 9 July. But if the tariff tensions subside a bit over the summer, then probably economic indicators would suggest that the Eurozone economy would start to recover late this year. And then actually, with an inflation outlook, we are at 2, will remain close to 2. I wouldn't see a reason for a cut.
Holger, when you look at euro level, so this has actually helped with inflation. We spoke to the vice president of the ECB yesterday, and he said, look, 120 is a danger. I mean, do you worry that actually if euro becomes too high, it starts becoming a real problem for central banks?
I think it's a modest problem. The currency moves that we've seen this year by historic comparison are not really very disruptive. The economic effect of what we see now, dollar euro, is probably in the range of 0.1 percentage points on Eurozone GDP. It's a bit on Eurozone inflation, but it's not really, in my view, a big game changer. The thing is, if, of course, we now go rapidly 120 and then above 120, the mere speed of the rise of the euro would then be a concern. But so far, this is an orderly adjustment to new circumstances. The US is less popular with investors for one reason, Trump.
When you look at the strategic review, is it easier actually to understand, they're moving to, or they're thinking about moving into scenario-based expectations. Is that easier to deal with Trump tariffs and to try and understand, I guess, the Venn diagram of the different decisions that could take place?
It doesn't really make the decision much easier, but it does inform the debate. It's good that the ECB now has more of an organized what-if debate, because in this world there are a lot of what-ifs. But it basically means that they think ahead of time what might happen if. It doesn't mean that the decision at the moment, when you don't quite know what's going to happen, is really informed by that or structured by that. I find it a nice exercise. Having said that, the result of the strategy review, in my view, doesn't give us much of a clue about what happens in the future, because it seems to codify the way in which the ECB debate has indeed moved over the last few years anyway.
It's tough being a Fed the Fed governor right now, the Fed chair right now, given all of the uncertainties on the economy. When do you think we start seeing a little bit of anxiousness actually, show up in the data?
Well, Fed Chair Powell here in Sintra said that he expects to see some inflation impact over the summer. And this is roughly in line with our view and the view of many others. Eventually, the huge inventory buildup that we had, the huge trying to beat the tariff surge in US imports, will be through. And hence, prices are likely to rise somewhat over the summer, which is actually one reason why I think that in the end, over the course of summer, Trump will prefer to strike deals rather than to explain to congressmen, to explain to the public, prices are higher. Why is it that? Wasn't my tariffs, or was it?
But Holger, is it possible that the U.S. economy is just much more resilient than we thought?
That's a separate issue. The US economy is resilient. We've said that for a long time. Don't bet on the US consumer going down. Don't bet on anything like a US recession. Trump would have to get much, much worse, or more precisely, he would have to follow through on his worst tariff threats to really sink the US economy. US households, they have a job. They do have a significant wealth effect from equity markets, and they are used to some political noise. So for now, it looks like an orderly deceleration of US growth, but not anything worse than that.
But so if the companies are strong, is it possible that they absorb some of the inflation costs before passing them on? So that, again, the delay is much longer than we think.
That's, of course, possible. Still, with consumer demand not flagging, I'd be surprised if US companies take much of the damage from the tariffs for a long time. And I would also be surprised if exporters from the rest of the world simply just took the hit. It would be very much against economic experience. Ultimately, the consumer pays.
Holger, I mean, look, I had a really, quite interesting and fun time moderating the panel. Is there anything that surprised you the most? I mean, the interplay between Bank of Japan, but also Bank of Korea, for me, was quite telling.
First of all, it was a well-moderated panel. Thanks a lot to you for that. Really, I liked it.
A compliment, but okay.
No, you weren't fishing, but you really, I thought, if I would have had a list of questions I would like to have posed, all of them were on it. Great, good.
Jake.
So, what I found most telling is, of course, Jay Powell. The way he clearly said we are on hold because of tariffs. The clarity of the statement surprised me, and also the clarity of many other statements. I found, okay, for central bankers speaking publicly, that's unusually clear. As to the Bank of Japan, of course, they don't quite know. Interesting interplay between them and the Koreans, but the basic message seems to be probably we will have to hike rates again in the foreseeable future, but we, of course, have to wait what now happens with Trump tariffs. And Japan Trump tariffs are among the issues of the day today.
Yeah, it's true, Holger. There was a sense, actually, that they had a purpose, right? That they felt like this was an important moment in history where they had to play the role. Thank you so much. I'm blushing. No one makes me blush. Holger Schmieding, the chief economist at Berenberg. Now, coming up, the UK Prime Minister, Keir Starmer, abandoned his welfare reforms to avoid a crushing Commons defeat. But at what cost? We'll break down the implications of that next. And this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
The level of household and corporate debt in the UK economy is actually lower than we would have expected it to be but based on past experience. So again, that feeds through into just how restrictive policy is at a given interest rate. It's somewhat less restrictive probably than it would have been historically.
Andrew Bailey there, the Bank of England Governor, speaking here in Sintra. Now to the UK now, where after markets, UK Prime Minister Keir Starmer dramatically abandoned his flagship welfare reforms to avoid his first ever parliamentary defeat. But at what cost to his authority and the nation's finances? Well, our UK correspondent Lizzie Burden joins us now for more. So Lizzie, this was interesting. It was rather unexpected that he abandoned it. How weakened is the Prime Minister?
Oh, really weakened, Francine. I have to say he had an ugly choice before him. On the one hand, he could have accepted a humiliating defeat in the Commons. He should be able to pass his flagship legislation when he's got this huge historic majority. Or on the other hand, he could have made this embarrassing U-turn, but he went for the U-turn, which meant that he had to drop the most contentious part of the welfare bill. Some Labour MPs had called it Dickensian, because it was all about restricting benefit payments to disabled people from next year. But as you suggest, the cost is both political and economic, because it means he's given up all the savings that he would have got from the reform. That means it's even more likely we'll have tax rises or looser fiscal rules by the autumn. That means that the Chancellor's job's on the line, the Prime Minister's weaker, and all the while the government's still billions in the red.
Lizzie, there's also bad news for the Chancellor from the fiscal watchdog.
Yeah, the OBR admitting yesterday that actually it's more optimistic than the consensus of economists when it comes to its medium-term growth outlook. So bad news for Reeves, because by the autumn, when she puts out her budget, it could be that the OBR downgrades its productivity and growth forecasts. That means she has less headroom. We know that her headroom already is a wafer-thin margin against her fiscal rules, so even more likely that she's going to have to raise taxes, which doesn't help with the growth picture. That means that the UK would be in a doom loop. And Francine, it really leaves very few options for Reeves and Keir Starmer when it comes to making up that growth shortfall. Do they need to make even closer ties with Brussels? Not going to be popular with all the Brexiteers.
Lizzie, thank you so much. Lizzie Burden there with a roundup of UK politics. Now, President Donald Trump says he's sticking with his July 9th trade deal deadline while renewing his threat to cut off talks and slap duties on various nations, including Japan.
You're writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough, and therefore you'll pay a 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
Well, joining us now is our EMEA News Director, Roz Matheson. Roz, good morning. So do we have a response from Japan? Could there be a compromise on rice?
Well, it's very difficult to see where the compromise might be. As you were just noting, Japan is now the country very much in the crosshairs with Donald Trump on trade. We did have a response from the Prime Minister, Shigeru Ishiba, overnight, but in a way what he was saying is just reminding the US that Japan is the biggest investor in the US, and there's a lot at stake here for the US as well. I mean, Japan's adopted a policy here in its negotiations of being firm but pretty friendly. The question is, does it sustain that? Does it take a harder approach? The idea from the Prime Minister seems to be that he would prefer no deal at all versus rushing to do a bad deal, because he has domestic factors here very much front of mind. There's an upper house election coming in Japan in the near future this month. Of course, he's got two key lobbies to think about: the auto sector and farmers, the agricultural sector. I mean, rice aside, in the car sector, that's almost 10% of Japan's GDP, 8% of the workforce. So a very important part of the Japanese economy to take care of. Rice, again, farmers are an incredibly important lobby group and voting bloc in Japan. And that's why for many, many decades, you've seen Japanese governments successively take a lot of careful care of the farming sector. And so very hard to see movement on rice, hard to see movement on cars. The question again is, like, is there anything that Japan can cede the floor on a bit here to get a deal?
So, Roz, I mean, if you look at Trump's tax on spending bill just passing through the Senate, it heads back to the House. Are there any more hurdles there?
Well, there are quite a few hurdles still to getting this done. I mean, this bill is squeaked all the way through so far. It got through the House in its initial state by one vote. It got through the Senate with the tie-breaking vote of the US Vice President J.D. Vance. It's back in the House, but it's in a different form. And so the Republicans can only lose three members with this to pass if all the Democrats vote against it. And that's a very slim margin because we're already hearing that Republicans are not happy with the version they're now presented with again in the House. And the challenge is you've got two different groups here. You've got moderates who are saying, hang on, you're cutting too much here in this bill, particularly again around things like Medicaid. You've got some Republicans saying you're not cutting enough, you're spending too much money, we've got to find more. So squaring that when you've got two very different groups here and making sure all those Republicans are willing to get over the line is very difficult. So that's going to be the challenging part, is they've only got 3 spots they can lose. We know at least 2 who are very much against this bill in its current form. So it's going to be a negotiating exercise. The question is, Donald Trump is really much the person who's pushing this himself. He's out on social media. He's saying to these Republicans, if you go against this, watch out. So again, there's a little bit of leverage potentially there from Donald Trump himself, just using his own influence to try and get this over the line, but it's going to be close.
Thank you so much, Roz Matheson. They're a terrific roundup, of course, of what we can expect in the next couple of days. Now, as Elon Musk moves to shore up Tesla politics, back at the fore, in particular, his relationship with the U.S. president. We all saw the tweets. Now, Trump has suggested that Doge, the cost-cutting effort Musk himself helped set up, could be unleashed on the subsidies for the billionaire's business. Well, we're now joined by Craig Trudell, Bloomberg's card czar. Craig, I have to say, I mean, it's like a telenovela. It unfolded in really ugly ways. Just when it appeared that Musk and Trump had entered a kind of détente, a new war of words. What's going on?
Yeah, I think there was a lot of reason to think that these two both had a lot to lose to continue to be at each other's throats. And yet here we were again yesterday with Musk, really, continuing, I think, a days-long sort of diatribe against the spending bill, and Trump really throwing some really firm brushback pitches and threatening the subsidies for his companies. Tesla in particular is really vulnerable here. There's only so much one would reckon that the U.S. can do to SpaceX when it's so reliant on that company for its launch business and for products like Starlink. Yet Tesla is in this position of, as we've known for months, being really in a tough spot when Trump has made it very clear that he is not a fan of Biden's policies to incentivize electric vehicle purchases. The writing was sort of on the wall there, and it seemed as though Musk was willing to sort of overlook that as he was really sort of, emphatically behind the president. And yet, as push has come to shove, we've seen him really get critical of this budget, which would pretty significantly pull back on support for EV purchases and potentially hurt incentives as well for manufacturing of batteries, which I think a lot of people sort of overlook when they take stock of all the support that has been put in place to get the EV business going in the U.S.
Yeah, I mean, Craig, there's heightened scrutiny as Musk takes greater control of Tesla again to revive sales. Another top executive has left. So what does it mean for the company? Can he actually hold it together?
Yeah, it's interesting. So last week, Bloomberg broke the news that Omid Afshar, one of Musk's longtime deputies, had left the company. And this was a big change because he had a lot of responsibilities, a lot of reporting lines that now have to be divvied up. And one of the things that we reported just yesterday in a follow-up story is that Musk will take responsibility for sales in the U.S. and Europe. And there's some irony here, of course, in that, Musk, I think a lot of people have concerns about, just to what extent he is the problem here and a big factor in why this company is having so much, of an issue selling vehicles. We will get a better sense of just how much, this company is in trouble from that perspective later today when they report vehicle deliveries. The expectation is for another decline sort of in line with the 13% drop in the first quarter, and that would leave them in a pretty big hole to dig out of to avoid a second consecutive annual drop.
Craig, thank you so much. As always, Craig Trudell there, Bloomberg's Global Autos editor. We'll also have to talk about deportation threats, but we'll get onto that later. Now, back to the ECB's annual conference here in Sintra. Most of the policymakers we've heard from share the view that additional rate cuts are probably ahead this year as the impact of U.S. tariffs become clear. Now, for more on the main key takeaways, we're joined by Alex Weber, our Euro area economy reporter. Alex, so good, so good to spend a bit of time together, because we always like to tap you for insights on the ECB, but also to get your thoughts on what Christine Lagarde said yesterday. I mean, she didn't cry victory, but actually the ECB seems to be in a much better place than all the other central banks.
Yeah, there's definitely the sense that policymakers feel they're in a really comfortable spot. As if to underline that the euro area inflation reading came in exactly at 2% yesterday, so that was really helpful for the message Lagarde sent on the panel. It's supposed to come in a bit below that level in the coming months, but still policymakers feel like they've done the job. And now it's just monitoring the various shocks that are out there. So there's definitely a bit of paranoia even out there to see how things pan out on trade. Situation in the Middle East was a stark reminder that things can still go wrong.
Alex, I mean, this is a loaded question, but how much is this thanks to the ECB, the fact that they cut 8 times and so now they're in a better place? And how much of it is actually luck of the draw, that, you know, they had the euro on their side, that there's a number of things structurally that means that it's just a little bit more comfortable being in Europe right now, being the central banker to Europe, than it is the rest of the world?
That is really a tough question. I mean, for the ECB, they're kind of running a victory lap now. They feel like it was down to the ECB to a large extent. Of course, they were helped to a large extent by energy costs. Just like energy costs punished them when inflation was rising. When it came down, it was also a lot due to that factor. On the other hand, the signaling from the ECB, the hawkishness, did also send a message to companies, to labor unions, that the ECB is on the job. So the wages are a big part of the story. It's really difficult to say. It probably would have unfolded very differently had the ECB just stayed on the sidelines.
What will be the main key takeaway that you take away from Sintra? I know a lot of the focus has, of course, been on Jay Powell and the fact that here he can speak to peers that understand the pressures he is going through, even if he gets attacked by President Trump on a daily basis. Yeah.
It's true that for the ECB, we didn't learn a whole lot of news on the rate path. It seems eminently clear there's going to be a hold in July, and then possibly, and there's some openness to cut further in the fall. The most interesting bit was perhaps the comments we got on the euro. So usually the ECB is very hesitant to comment on the exchange rate. They say they take it into account, of course, because it matters for inflation, but they don't want to be seen as targeting a certain level. This time was a bit different. There were really explicit comments on some showed real concern about what this means for the economy, could weigh down on the economy, could further depress prices. So this is something that could really tilt the balance in the fall toward further cuts if the exchange rate continues to develop as we've seen, if the euro keeps strengthening.
So interesting. Thank you so much, Alex Weber there, our Euro area economy reporter. Now, coming up from Sintra, we'll have plenty more interviews of Bank of England policymaker Alan Taylor and the governor of the Bank of Finland, Olli Rehn. So those interviews coming up in the next hour. Up next, a Bloomberg Brief, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
You have had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. we think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. On to the House. President Trump's tax bill faces Republican resistance with a vote scheduled today. No delay. The president sticks to his July 9th tariff deadline, threatening Japan with levies up to 35%. And the biggest banks on Wall Street boost their dividends after passing the Fed's stress test. Well, momentum starts to wane. We hit all-time highs, and then we fell yesterday. There's a big rotation out of momentum and into value stocks that in some way continues into the future session this morning. S&P higher by about 1/10. NASDAQ underperforming. Russell 2000 outperforms. That's up 0.5%. We've also seen yields tick higher both yesterday and today after we had JOLTS data yesterday showing a still tight labor market. So some of the cuts for the Fed starts to get priced out. We're moving up by another basis point, about 1.5 for your 2-year yield. Your 10-year yield's up 4 basis points this morning, a chunky move on the long end. We are at 4.28 for your 10-year yield. Let's look at some of the stocks moving in the pre-market now. With that is Joe Easton. Hey, Joe.
Hey, Danny. So we've got Paramount Global in the spotlight today. The shares edging higher as the company reaches an agreement with President Trump, who had sued the firm over its coverage of the election. The firm had shown on their CBS channel 2 versions of an interview with the presidential candidate Kamala Harris, and that had led to a lawsuit from Trump, who had sought around $20 billion in damages, but they're looking like they're going to pay around $16 million to settle that. That is taken positively. Meanwhile, Stellantis getting a little boost as well, seeing some strength in some of their truck names in their latest quarterly sales report. The overall numbers, the overall quarter actually look pretty weak, but it is the truck sales making up for some weakness in Jeep and Chrysler as well. Then finally, Goldman Sachs analysts ditching their Crocs this morning, no longer wearing them to the office. They are downgrading, or at least initiating a sell on Crocs this morning, and that stock is declining 1%. They do have a price target significantly lower than where we are trading currently. Keep an eye on Crocs today, and as usual, check out the Before the Bell opening wrap for a summary of these news and more. Danny.
Joe, did you just imply that you have a pair? Is that what that was?
Yeah, well, it's whenever I should wear them on set, really. It would be, I'd glide around a little bit more easily than these clumpy loafers.
Joe, the picture of fashion, I hope you put them in sport mode just to make sure you can do those market checks just as well.
Absolutely.
Joe, thank you so much. We'll catch up with you later in the hour. And this hour in just moments, we'll speak to Allspring's Lauren Van Biljon on the Fed's rate path. Later in the hour, we'll speak to Signum's Nico Fitzroy on the looming tariff deadline. First, we take you live to Sintra, we'll take you live to Sintra for a conversation with Alan Taylor, external member of the Monetary Policy Committee at the Bank of England. All of that this hour. Now, speaking of Sintra, Chair Powell spoke there at the ECB forum yesterday on the rate path ahead for the Fed.
We are going meeting by meeting. I mentioned, how I'm thinking about that, but I wouldn't take any meeting off the table or put it directly on the table. It's going to depend on how the data evolve. But as I mentioned, a majority of us do feel that will be appropriate in the remaining 4 meetings of the year to begin to reduce rates again.
Allspring's Lauren von Benyon weighing in with her outlook, writing, quote, current pricing out of U.S. is for 2 cuts this year. Reality could be more binary, i.e. nothing at all from the Fed until 2026, or a series of rapid cuts into year end. Lauren, I'm pleased to say, joins us now. She's fixed income portfolio manager at Allspring Global Investments. Lauren, so great to see you this morning. So what is the risk, the greater risk for this bond market then? No cuts this year or a series of cuts?
I think the latter. On balance, I think this is a Fed that wants to cut, is looking for the data to let it cut. And I think we'll probably get there for the September meeting. The jobs numbers have been obviously the driving force of late. And just enough sort of stability leaning to weakness there that I think we'll see some cuts out of the Fed this year.
It was a Powell in Sintra, though, Lauren, that was quite relaxed. He repeated this thing that he has said previously, that had it not been for tariffs, they might have been cutting. He also went on to name what keeps him up at night. The number one thing was price stability. And Bloomberg Economics' Anna Wong looked at that and said that this is a Powell who aspires to be like a Paul Volcker, who stays steadfast in the face of external pressures, and therefore his bias will be not to cut. I just wonder what you make of that.
I think certainly Powell is, obviously his driving force is price stability. He's going to be thinking about his legacy as he hands over control of the Fed next year. But I think where rates are right now, they've kept them tight for a significant amount of time. And I think looking into the second half of this year, yes, there's upside risk from tariffs. We'll certainly see seeing that playing out in, say, household goods or tech. But I think there are 2 big components that are going to help sort of ease the Fed's mind, and that's energy and that's housing. And I think the outlook for both of those is disinflationary over the next couple of quarters. And I think that'll let the Fed look through the price shock of tariffs and focus on some potential easing.
So given that they could have some potential easing, Lauren, is this a front end to the curve that you'd want to be buying right now?
Yes, I mean, Allspring, one of our big calls this year has been for that steeper curve. And it's been interesting that it's been bull steepening rather than the bear variety, perhaps. But it does say to us that where the curve is right now, and given, say, tax risk and the lingering policy risk, yes, it does feel that bull steepening has got more to come. I think particularly the very long end of the curve, that continues to struggle to attract a lot of interest, both from domestic and offshore buyers. But yeah, that sort of more intermediate end of the curve, yes, that's where we could see more of the action.
Well, we've had that narrative really bubble up this year, Lauren, that especially external buyers, foreign buyers, would start to snub the long end of the curve. And yes, it has been under pressure, but auctions for the most part, yes, there's been a 20 here and there that haven't looked great, but auctions for the most part have drawn in demand. What do you make of the state of demand, especially as it pertains to foreign buyers of this Treasury market?
There's been a couple of really interesting things happening the last couple of months, because as you say, auction demand has been fine, right? That's still clearing, it's still coming through. I think there has been a preference for shorter dated securities, and I think where a lot of the action has been on hedge ratios. So you've had foreign investors perhaps hedging a far greater share of their US holdings than they might have done in the past. And I think it's been that shifting hedge ratio that's played a role in the weakness of the dollar. The US bond market it's a deep and liquid and incredibly important bond market, and that just can't disappear overnight. I think there is a risk that your, say, marginal buyer of treasuries is now thinking about alternatives. That's certainly a possibility and something we're looking at very closely. But I think people are still very happy to be invested in the US, perhaps just a little bit more cautious on how they're hedging the currency exposure.
Lauren, to your point, it's the most deep and liquid market. So what is the alternative for the marginal buyer that wants to find one?
Looking at flows, the answer seems to be a little bit of everything. Certainly at Allspring, we think securitized credit's offering a great opportunity. And perhaps barbell to that, emerging market local currency debt has had an absolutely stellar 2025, both on the bond and currency fronts. And that could continue to attract interest. Obviously, Europe has seen some flow as well. But to me, that perhaps is slightly more played out at current valuations. So I think you can look at some of the smaller emerging and developing economies where you've got decent yields, you've got sound policies, you've got sort of a wellspring of domestic demand, perhaps offering some insulation from trade tensions. And you can say that is still an attractive destination for investment.
All right, Lauren, we're going to have to leave it there. Thank you so much for joining this morning. Lauren Van Biljon of Allspring Global Investments. Let's get you some other stories now that are trending on the terminal this morning. The Trump administration is halting key Ukraine weapons deliveries as Russia steps up its missile and drone attacks. The White House confirmed an earlier report from Politico on the stoppage. It said the move came after U.S. munition stockpiles had fallen too low. President Trump says Israel has agreed to a 60-day ceasefire in Gaza. The president said that Qatar and Egypt will deliver the final proposal to Hamas. Israeli Prime Minister Benjamin Netanyahu is set to meet with Trump on Monday. Meanwhile, KKR has agreed to buy Spectris for around $5.5 billion, outbidding an offer from a consortium led by Advent. The private equity firms have spent the last month trading bids for the British company, which makes precision testing equipment and software. The offer values Spectris at about £40 a share, a 6% premium on Advent's bid. Coming up, back to the House. After barely passing the Senate, President Trump's tax bill is set for another vote-a-rama today. We'll have more of that next on your brief. You're watching Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's Jobs Day, and Bloomberg has the report under surveillance.
There is this feeling the labor market is contracting.
There's some risk that layoffs are growing.
Medium-term outlook is the economy should be fine.
This Thursday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
The weakening trend continues.
This is a trend. We're seeing declines.
If you're not with a job right now, it's harder to find a new one.
The June Jobs Report, Thursday on Bloomberg.
look forward to the House taking legislation and getting it to the President's desk.
And you believe this bill will get to the President's desk by July 4th?
I do believe we have a good chance to get it done. I can't speak for the House, but that is the goal. And so far, we've been able to reach those goals.
I don't know what's going to happen in the House. They're going to take it up pretty soon. Do they have the votes to pass exactly what we did? I don't know.
House lawmakers returned to Capitol Hill today to vote on the Senate's version of the tax bill, which passed the chamber on Vice President Vance's tie-breaking vote. For more on the latest in D.C., let's bring in Bloomberg's Suzanne Lynch. Suzanne, what sort of uphill battle does the president's bill now face in the House?
He does indeed face an uphill battle. These votes have been very tight all along. Originally in the House vote, as we saw in the Senate when Vice President J.D. Vance had to cast that tie-breaking vote, and now as it goes back to the House. And a number of lawmakers, interestingly, both from the more conservative side and the moderate side, have expressed reservations about what they have to agree to now. Obviously, Conservatives are worried about what this means for the deficit, for the debt levels, the U.S. fiscal policy and the Republican Party's fiscal policy. And on the other side, those deep cuts to Medicaid is an issue that a lot of more moderate Republicans are concerned about. So, it's going to be a very closely watched session, another vote-a-rama, as you say, but let's see if it gets done before that July 4th deadline.
So we have two big deadlines, self-imposed as they might be, coming up. July 4th for the tax bill, July 9th for the tariff deadline. And on that, President Trump has spoke with it. Suzanne, this is what he had to say. Let's take a listen on a quite pessimistic tone on a deal with a key ally.
We've dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough. And therefore, you'll pay 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
If this is the president digging his heels in when it comes to Japan over issues like agriculture, over rice, for example, how does it suggest about the likelihood of getting more deals done by July 9th, Suzanne?
Yeah, I can tell you that those comments are being closely watched by trading partners across the world. We are really hitting crunch time now for US talks with its trading partners ahead of this July 9th deadline. The European Union, its chief negotiator, has flown to Washington. Maros Sefcovic, he's due to meet senior officials, including Mr. Greer, the US trade representative, on Thursday, and will report back in Brussels on Friday. And those comments, at least, suggest a hardening of the stance by the US president. That warning to Japan, obviously, as he said himself, there's still that big trade deficit. He's concerned about the auto industry, for example. So if he's going to take that hard line on Japan, is he going to do it with the European Union too? Now, there is a feeling, we've been reporting here over the last few days, that the European Union is getting more comfortable with the idea of a 10% universal tariff. However, what they also want is some kind of carve-out or reduction for other sectoral tariffs, like be it automobiles, steel and aluminum. Also, the big question is, what is the US administration going to do about pharma tariffs? It's threatened that. They have not come so far, but is this still at the table, on the table? So to that extent, I think those comments from the president are very telling. And of course, as you mentioned there, the fact that this is all coinciding with the July 4th deadline, I think people across the world, trading partners, are looking to see, does Donald Trump get that deal done for July the 4th, so that can kind of clear the decks for serious negotiations to happen in the remaining days before the July 9th deadline?
So just on that Bloomberg story we had the other day about maybe warming up to a 10% universal tariff, does that mean that the EU is less likely to retaliate if that is indeed what comes out of these negotiations?
Yeah, I think the issue is, if they agree to a 10% tariff, well, then they were going to have to get some leeway on those other sectoral issues. And if they don't, I think then they still have this option of hitting back with their own countermeasures. Now, always with the European Union, it's a massive trading bloc, but it consists of 27 countries. So the debate that's happening in Brussels is that some countries are saying, let's go easy. We don't want to, antagonize the US and then prompt more measures. And where others, particularly France, is a strong voice here saying, listen, we're in a strong position and we cannot just accept this and not have some kind of movement from the US side on those sectoral tariffs. So I think that a basket of measures it's ready to run with are there. And that is the leverage, essentially, that the European Union has as it goes into these final days. But look, as I say, happy to live probably with the 10% tariffs, but needs movement in other ways.
Suzanne, thank you very much for that, for all of your work this morning. That is Bloomberg's Suzanne Lynch. Coming up, looser stress test for Wall Street's biggest lenders boost dividends. That and more on your front page headlines. It's coming up next.
In case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. With all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Our global headquarters in New York, I'm Dani Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
It's your Bloomberg Brief. I'm Dani Berger in New York. Let's take a look at the front pages this morning and what the major publications are running with. First up, the Wall Street Journal, leading with China quickly gaining ground on the U.S. in the AI race. Institutional users of AI ranging from universities to multinational banks are turning to Chinese LLMs from the likes of DeepSeek and Alibaba as an alternative to Western models. And on the Financial Times, sales of European junk bonds surged to their highest level ever in June as capital continues to flow away from U.S. markets. Low-rated companies saw their issuance rise to about $27 billion. That's according to data from J.P. Morgan. And on the Bloomberg, Wall Street's biggest lenders are boosting their dividends after passing this year's less stressful Fed stress test. For more on the story, we are joined by Bloomberg's managing editor for EMEA Finance, Tom Metcalf. So, Tom, what have we seen from the banks and the resulting payouts being upped?
Yeah, well, basically across the board, payouts are up. The one that probably jumped out the most is Goldman, which is increasing its dividend effectively by a third from $3 a share up to $4. So that's a pretty big jump. And, you know, obviously the shares previously, when it was announced they'd passed their tests, had already risen. What will be interesting to see today is, as the sort of markets digest these increases, like, will there be any more kind of uplift in the shares, or has it all been priced in?
So has it all been priced in? But what other optimism is priced into banks? Tom, the third best performing sector so far this year is financials, up about 9%. There's been widespread hopes for deregulation for the U.S. and really across the globe. How apt are those hopes? Do they seem like they'll be playing out?
Yeah, look, I think the sort of posture generally towards finance has obviously dramatically shifted since, you know, kind of the dark years after the financial crisis. And I think it's that deregulation piece, which maybe is the most tangible. You know, there's a lot of talk about support in finance in the finance industry, but what's most interesting is when, you know, the regulators actually take action. I'm sitting here in London. There's certainly been a push for that. Obviously, in the US, there's been a real kind of move towards that, which you could really contrast with what, you know, under the Biden administration they were trying to do with the Basel rules. It now looks like those Basel rules might not even be implemented in kind of the extreme case for the US banks, and that's cascading across the world. So, you know, almost every region you look at, finance, you know, and what's quite a turnaround, is now seen as there's a lot of trends pushing it towards, you know, higher profits thanks to, you know, sustained higher interest rates, and of course, you know, the politics and the regulation sort of easing against banks.
Well, there's the political side of it, and that coming from Washington, D.C. and other lawmakers. But there's also the monetary policy side of it, Tom. When you have the Fed talking about things like SLR reforms, or even having a more lenient stress test this time around, is this a Federal Reserve that's trying to gear American banks to be able to handle ruptures more readily?
Yeah, look, I think there's been a bit of a change in tone, and I think generally there's a bit more acceptance that, look, you can't, you know, exclude risk. As basically what the role of the regulator is to make sure people are taking that risk, at least informed of them, and sort of are in a position to kind of make that decision. And, you know, certainly where the US, you know, leads, everyone else is going to be following. So in the UK, similarly, you've gone from almost quite a nannying posture from regulators to at least public statements saying, hey, we're looking to encourage growth and we're not looking to sort of clamp down too stringently on banks that follow the rules, but are also out there looking to make money.
All right, Tom, thank you very much for that. That is Tom Metcalf. And again, the bank's not moving a huge amount this morning, but they did see larger moves on Tuesday. For example, Bank of America moving 1.7% on Tuesday in reaction to passing the stress test. Overall, your American equity session in this futures trade, little change this morning, up about just 0.1% after declining yesterday. The dollar snaps back some of the losses that it has seen. It is gaining, with your 10-year yield and really duration under pressure this morning. Yields higher by nearly 4 basis points. Coming up, trade tensions are on the rise between the U.S. and Japan. Nico Fitzroy of Signum Global Advisors joins us next to weigh in on the talks as the EU trade advisor heads to Washington, D.C. That's next on your brief. Stay with us.
Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Buenos Aires, Argentina, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Wednesday. On to the House. President Trump's tax bill faces Republican resistance with a vote scheduled for today. No delay. The president sticks to his July 9th tariff deadline, threatening Japan with levies of up to 35%. And the biggest banks on Wall Street boost their dividends after passing the Fed's stress test. So the momentum wanes. Earlier in the week, we hit all-time highs, only to see declines yesterday, and a little pop higher on your future session, about 0.1% for S&P futures. Worse for the NASDAQ, even more for the Russell. There's been this weird and curious rotation out of momentum and into value, and that seems to continue this morning. For the bond market, it is continued pain. We are higher, especially on the long end. Look what's happening for your 30-year yields. We are higher by nearly 5 basis points at 4.8. The bill making its way through D.C. and also a more tight labor market in the JOLTS data yesterday will tomorrow confirm that. Your 10-year yield at 4.28. Let's get some stocks moving in the pre-market. With that is Joe Easton. Hey, Joe.
Hey, Danny. So we've got Paramount Global in the spotlight today as CBS settles a lawsuit with President Trump. Now, Trump had sought around $20 billion in damages for some of their pre-election coverage, where CBS showed 2 versions of an interview with Kamala Harris. Trump wasn't happy about that, but they've settled this, and they are only going to be paying around $16 million. So pretty loose change in comparison to what was sought. Then we move over to the health insurance space. A big decliner today, Centene, plunging this morning as they pull their guidance, seeing it around a $1.8 billion hit due to a weakening market, set to be one of the biggest decliners in the open this morning. And then finally, Goldman Sachs analysts are shunning Crocs, no longer wearing them when they're doing their research reports. They're cutting that one to sell, or at least initiating with a sell. This is due to competition. Believe it or not, there are actually competitors to Crocs, according to Goldman Sachs. They think you should be selling Crocs shares this morning, and the stock is declining 1.5% this morning, Danny.
What is a competitor to Crocs? Who else makes shoes like that?
It's so unique. I mean, how do you substitute a Croc?
Yeah, because you'd have to be out of your mind to make a plastic shoe that looks like that, Joe. I'm going to leave it there. I'm going to get some hate mail for that, Joe. Thank you so much for your work this morning. All right, let's get away from Crocs and switch our focus to trade. President Trump ramping up his tensions and attacks with Japan for a 3rd straight day.
We dealt with Japan. I'm not sure if we're going to make a deal. I doubt it with Japan. They're very tough. And therefore, you'll pay 30%, 35%, or whatever the number is that we determine, because we also have a very big trade deficit with Japan, as you know.
Meanwhile, the EU's chief negotiator, Mariusz Sefcovic, is now also headed or is in Washington, D.C. right now, and he will be meeting with the U.S. Trade Chief Negotiator Jameson Greer and Commerce Secretary Howard Lutnick. Now, our next guest writes, we believe that U.S. President Donald Trump is likely to raise tariffs on many countries, including those of the EU around the tariff deadline, despite regular media chatter of progress in transatlantic talks. Joining us now is Nico Fitzroy, Senior Analyst and Partner at Signum Global Advisors. Nico, really wonderful to see you this morning. So what is your expectation as to whether the EU gets some sort of agreement with the U.S. by July 9th?
Well, I think progress has been made over the last couple of weeks. Bloomberg obviously reporting earlier this week that the EU accepts now that a 10% blanket tariff will remain in place. And I think that's an important step towards a deal, because that 10% blanket tariff was something clearly that the US was not willing to give any leeway on. So that does make a deal a little bit closer potentially, but does it make it likely? And I think the problem here is the two things that come because of that perceived concession on the blanket tariff make a deal still more difficult than not, I think. Two things. Firstly, from the EU's perspective, accepting a 10% blanket tariff is perceived by them to be a concession. From the US's side, it's not perceived to be a concession. So the US doesn't really feel like it has to give something up in return for that. That's a problem, and that's been one of the problems, I think, throughout the negotiations, the two sides talking past each other a little bit. The other thing is that actually the EU, in order to accept that 10% blanket tariff, it wants something positive to come from the deal, and that basically will be either exemptions for kind of key, national champion type sectors, alcohol, pharmaceuticals from that blanket tariff, or a reduction in auto tariffs. Both of those look difficult to agree. I mean, Trump hasn't shown much interest at all in exemptions from the blanket tariff. And when it comes to the autos sector, we've heard him many times talk about asking the question of why we buy so many cars from Europe. Germany treats us very badly when it comes to cars, etc. This is a big bugbear of Trump, and I think he's therefore less likely to make concessions on autos for the EU than he was for the UK. Obviously, the UK did get a deal on quotas there. So the balance of probability still suggests that a deal is unlikely despite some of the positivity there, but I would concede it's a little bit closer.
Internally, though, you have the likes of Merz, of Maloney pushing for a faster deal. Do they hold enough influence within the EU to change the messaging to maybe something like a bad deal at this point is better than no deal?
Yeah, I mean, it's definitely true that there are a number of leaders that potentially want a bad deal rather than no deal. I think the problem here is that, well, you've got a couple of problems. Firstly, they have to achieve some kind of concessions from the US. And so maybe a reduction in steel and aluminium tariffs is something the US can grant. But, Germany is a great example where, okay, Merz wants a quicker deal. He wants a deal that maybe isn't even that good as long as he gets it quickly. But for him, the most vital thing of all is getting reduction in autos tariffs. So, okay, he wants a deal, but actually what he really wants is something that is very difficult to achieve. The other problem is a collective action problem within the EU. Even if you want a quick deal, different countries have different interests, and they're all pushing for different types of concessions they want from the US. And that means you get a whole host of demands across different sectors. So even though Maloney and Merz may appear to be pulling in the same direction, actually the things they probably want in return from the US could potentially be quite different. And that might be true across a whole range of different countries. So that collective action problem means that kind of unity in pushing for a quick deal is never quite what it seems with the EU.
Well, in order to do something like retaliatory tariffs as well, Nico, you probably need that unity. So where does that stand? What is the likelihood that the EU pushes back after the July 9th deadline if there is no deal and tariffs are increased?
Yeah, right. I mean, unity, is the biggest problem of all when it comes to unity is how to respond to the US. I think so far the EU has been very dovish in terms of its response. It hasn't actually implemented anything in retaliation to Trump's tariffs so far. It's passed one package worth just over 20 billion euros in tariffs that it can, implement. I think on July 14th is the date they're talking about, but essentially, immediately after Trump imposes any more tariffs. There's another package worth 95 billion-ish euros. In our view, the EU is going to remain dovish for a couple of reasons. I mean, firstly, the possibility of negotiations with Trump will always remain. There's always a chance of negotiating something even after July 9th. And that gives an incentive or a disincentive, I suppose, from the EU to respond very, very strongly. I think also what we saw, one of the examples that people talk about a lot is China, which went toe-to-toe with the US, responded with retaliatory tariffs at exactly the same level as the US, and ultimately the US kind of backed off. I think some people say that that's a kind of template for countries to use. I think when it comes to the EU, it's an example of why it can't escalate in the same way, because EU countries are not willing to live with 100+% tariffs potentially for a prolonged period. And certainly they don't believe they can outlast Trump on this. So retaliation is likely to remain relatively weak from the EU. I think probably potentially just limited to that 20 billion-ish euro package if they have to do something. The big question is whether they target US big tech firms and banks and other services. I don't think, to go back to the point about unity, I don't think there's enough unity among EU countries to do that. There are still a number of countries like Italy, Ireland, some of the Baltic states that really rely on security guarantees from the US. These countries don't want to retaliate at all. And so that normally means you get something close to the lowest common denominator, which means a fairly dovish response.
Well, there's also the more recent example of Canada that didn't want to remove their digital tax, and they got called out quite aggressively by Trump. And it's non-tariff barriers that Trump is also quite upset about when it comes to Europe, things like VAT, digital regulations, and digital tax. Is it really realistic that the removal of those barriers are on the table for Europe?
Yeah, I think it's a great point. I don't think the removal of many of those barriers is on the table. The removal, for example, of the Digital Service Act and the Digital Markets Act, these are not things realistically I think the Commission can offer. VAT, there is some positivity here, which is that VAT appears to have been reduced in terms of how much, not reduced as in the US is talking about this less. It may still be an issue, but it doesn't appear to be one of the sticking points in negotiations, which is potentially more of a positive. And I think when it comes to some of the climate and ESG regulations, actually a lot of member states are pulling in the same direction as Trump. So Merz and Macron, for example, among many others, are pushing to reduce the scope and potentially delay the implementation of a whole range of different pieces of EU regulation. And they would have done that anyway. So the interesting thing there is that they can say that they are doing that because of Trump and as a concession. So it's not, non-tariff barriers, there is definitely some overlap. But in terms of getting rid of some of the tech regulation, that remains very unlikely. And so that will always remain a problem, I think, in the relationship.
Nico, we're going to have to leave it there. That was an absolute masterclass. Thank you so much for joining. Please come back again soon. Nico Fitzroy of Signum Global Advisors. Now let's get you some other top stories that are trending on the terminal this morning. The Trump administration is halting key Ukraine weapons deliveries as Russia steps up its missile and drone attacks. The White House confirmed an earlier report from Politico that artillery rounds and air defensives have stopped flowing from Washington to Kyiv, reportedly after a review that led to concerns that U.S. munition stockpiles were falling too low. President Trump has said Israel has agreed to a 60-day ceasefire in Gaza. The president, posting on Truth Social, said the U.S. will work with all parties to end the war and that Qatar and Egypt will deliver the final proposal to Hamas. Israeli Prime Minister Benjamin Netanyahu is set to meet with Trump on Monday. Home sales in Manhattan last quarter were the strongest they've been in almost 2 years. Cash buyers boosted the market, undeterred by a backdrop of economic uncertainty created by President Trump's trade war. A little more than 3,000 co-op and condo purchases were closed in the 3 months up to July, a 17% jump in the period last year. Coming up, we go live to Sintra, Portugal, with Alan Taylor, external member of the Monetary Policy Committee at the Bank of England. That's up next on your brief.
Listen carefully. Can you hear the rhythm in the markets? not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Let's go live now to Central Portugal, where Francine Lacqua is standing by with the top voice in central banking. Francine.
Yeah, thank you so much, Danny. I could not be more happy to speak to Alan Taylor, of course, from the MPC Bank of England. Alan, thank you for joining us. I have a million questions on cuts, how big, how strong. But first of all, you've been in the job for a year. What's been the biggest difference?
Well, thank you, Francine. It's a pleasure to be here. It is coming up on a year, and I think that's causing me to reflect, especially here in a breezy Sintra, that the economic winds have been shifting. So the way I would describe the evolution of my outlook and my thinking is I think a year ago, as in many central banks, the view was that we were on track for a soft landing. We'd had a burst of high inflation. Rates had been elevated to counteract that. With high interest rates in the past, you would have normally expected some kind of slowdown in the economy, but that kind of damage wasn't happening. So there was a lot of optimism around that, and I think a sense that we were progressing back towards target without undue economic damage. Now, things have shifted. I think I would say now that soft landing is at risk, in my view. We've seen the economy slowing down in the UK. Inflation in terms of core measures coming back towards target. There is a bump in 2025, which we're going to talk about, I'm sure. But now my worry is when we get into 2026, we're coming back to target, but the danger could be overshooting to the other side, where we end up with the economy below capacity and inflation potentially undershooting. So I think that's the sort of then and now.
Yeah, and Alan, you've been very clear that you think we're still far away from where you think the neutral rate is. So would you go to bigger cuts?
I don't think bigger cuts are necessarily needed or desirable, but I think, we only meet 8 times a year. So there's a kind of integer problem. You've got so many cuts you can do in a year. The market has interpreted, gradual to mean once a quarter. But if you feel that a slightly faster easing might be needed, if you're worried about mounting downside risks, then you need to get an extra cut in somewhere if you think maybe 5 cuts are needed. So it could come at different points depending on how the center of the committee moves.
Will you vote for a 50 basis point cut again?
Well, I'm not going to prejudge my vote. I think everything has to be taken into consideration afresh each meeting. So as everyone likes to say, we're not on a preset path. It almost doesn't need to be said. But you have to look at the data afresh each time. And we're going to be getting new information on the trajectory of inflation. We're coming out with a new forecast in August. We're going to have more information about where wage settlements are landing, which is a particularly important indicator for me and for the rest of the committee. So I think we're going to look at that anew each time.
How much do you worry about the labor market and it actually deteriorating quickly? We've seen signs in certain data.
Yeah, I think we're starting to see cracks there. So the unemployment rate is rising in our new forecast. Latest forecast, it's going to top out at around 5%. Vacancy to unemployment ratio has been coming down very steadily. It was tight a year ago. That's another big change. And staff judgment now is that we've got some labor market slack. So I think we're in a point now where we've got slack in the economy, we've got an output gap. And so I'm comfortable there that the underlying inflationary pressures in terms of the demand and supply balance are now tipping the other way. So I think that's helping the disinflation process along quite helpfully.
In inflation, though, do you worry about second-round effects? I mean, again, there's concern about what happens after the trade negotiations in the next couple of weeks and months.
Right, so I think I'd maybe separate that into three little chunks. I know you've got a lot to go through, but I'll go with the rule of three here. So second-round effects, I worry about those most with energy, right? So energy is a key input. It's well up the chain in terms of, you know, it's upstream from a lot of things. It's an input used in many other sectors. So the energy shock, look back at the history of the last 50 years, what's taken us away from target the most? It's been two big energy shocks in the 70s and now. And so second round effects there are a big worry. Something like food, it's more of a final product. I don't worry about the transmission through the input-output structure of the economy, but you worry more there about does it dislodge inflation expectations. So I think the key to me there is to focus on expectations measures. They don't always disagree. Households, financial markets, businesses say different things. But I think that's maybe less of a concern than if we have an energy shock.
But so given, I mean, there was because of the energy shock, is there, you know, a worry that actually you have the deteriorating labor market, but also inflation going through a tough time in the next couple of months?
Yeah, so this was really why I was kind of a little bit in wait-and-see mode at the start of the year. In the first quarter, the first two meetings, I was hit with a lot of new data. The hump became apparent. A lot of that was from administered prices, so it wasn't really something predictable out of the demand and supply balance in the economy. It was news about electricity, about water, about taxes, about any number of things. Those stick around. Once they're in for 12 months. But we're fairly comfortable at the moment saying when that 12-month period comes to an end, they're going to start to fall off in 2026. So I think as we got more comfortable and more data came in, and the underlying measures, particularly the wage inflation I mentioned, we started to see wage settlements, which were coming in absolutely in line with our agents' pay survey. As we went through 2025 over the last few months, I felt more comfortable that that disinflation process is intact and it's progressing as I would have expected.
I need to ask you about QT because we had a hint yesterday from Governor Bailey that we may be getting a smaller overall balance sheet runoff in the next year of QT because of constrained liquidity at the end of the curve, at the long end curve. Do you think sticking to the £100 billion runoff would actually be too rapid?
Well, as the governor mentioned, we're about to go into the review of that. Actually starts this week, and we're going to spend 2 months poring over the figures, thinking about the situation. And the context matters. We're in a different place than we were a year ago. So that has to be taken into consideration. I mean, the broader context here is that we're transitioning to a different regime in the long run with liquidity coming through repo rather than through outright asset purchases. And that should be a gradual transition, and that's what we have in mind. So I think that destination hasn't changed. But just as we said a moment ago with the rate decision not being on a preset path, I don't think one should think of the QT being on a preset path either. So it's a very much a live decision. And I think we have to look at the context, liquidity in the market. How does it interact with monetary policy? We're voting as the Monetary Policy Committee. Do we think asset purchases and sales are perfect substitutes for bank rate? That may not be strictly true, not without a lot of very special assumptions. So I think all of that is going to be taken into consideration.
Okay, Alan Taylor, thank you so much for joining us. I have 1,000,001 other questions.
I'll come back.
So you'll have to come back. Of course, that was Alan Taylor of the MPC. Danny, with that, I'm going to send it back to you in New York, and we'll have plenty more throughout the day here from Sintra.
Francine, thank you so much. Really looking forward to your continued coverage and excellent coverage so far. Francine Lacqua in Sintra. Coming up, we're going to get you set up for your trading day. More jobs data ahead. This is Bloomberg.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Welcome back to your brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Wednesday. We're going to have more jobs data. The Challenger job cuts come at 7:30 a.m. Eastern, and then we'll get the ADP employment report at 8:15. Plus, Tesla's second quarter sales numbers are expected this morning. And the House of Representatives convenes at 9 a.m. House leaders say that they expect a full chamber vote on a rule that will pave the way for a final vote on the Senate's mega tax bill. All right, some individual movers this morning. Centene pulling its 2025 guidance due to an insurance market trends, earning $1.8 billion in revenue. Those shares a massive leg lower by 26.5%. Elvance Health, Centene also dragging down other health insurers down with it. That's down 4.5%. Finally, Adobe, that is some sell-side action for you. Cut to a sell at Rothschild's. The price target is at 280, currently trading at 30.86. Let's take a look at this bond market because it is under some extreme pressure after a decent first half of the year. It was yesterday's JOLTS figures that showed more openings, maybe a tighter jobs market than had been expected, plus the big, beautiful bill making its way through Washington, D.C. Does the very staid, sanguine nature that we have seen of this bond market over the past month get disrupted? 30-year yields, check this out, up more than 5 basis points at 481. All right, that's it for your brief surveillance. We'll take things from here. You're watching Bloomberg.
Villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There's broad participation in the market, but the magnitude of the upside is just in a handful of names.
It's been a very nuanced move in terms of inequity.
There still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries.
We're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback.
The risks are known, and once the market kind of knows risks, they can deal with it.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, one big bill making progress on Capitol Hill.
I felt the Senate was going to be tougher than the House. It's an amazing fact. It's the biggest bill ever passed if we get this done.
I look forward to the House taking up and passing this historic legislation and getting it to the president's desk.
They made it more conservative in some places and moderated it a little bit in others. This is no longer just a House bill. It's not a Senate bill. It's the bill of the people.
A major tax bill might be heading back into some Republican resistance in the House. As President Donald Trump looks committed to deadlines on both taxes and trade, Fed Chair Jay Powell reiterates if it wasn't for the tariffs, they would have cut rates already. The tension builds in Washington.
And it sounds like they're all different issues that are coming to a head at the same time, but it's actually quite similar. It's all coming down to who is going to pay for the increased spending or some of the tax cuts that are not fully funded. Is it going to come from tariffs? Is it going to come from Jay Powell cutting interest rates to 1%? Is it going to come from the growth of an economy that a lot of people aren't projecting out? But ultimately, that is the economic tension that is really the thrust of all of these issues, the bill, the tariff issue, as well as Federal Reserve Chair Jay Powell.
Super tight margins down in Washington, D.C., not just in the Senate, but also in the House. It's the job of Speaker Johnson to herd the cats over the next 24 hours.
It's going to be incredibly challenging to try to get this done by July 4th. Already when you see the outcry from a number of groups, and it's the same groups we've been talking about, these different factions that are vying, those that think the Medicaid cuts go too far, those that think there's not enough spending cuts, and then one or two SALT holdouts that are a little bit concerned about the edits in the Senate. The group to watch is the Freedom Caucus. Treasury Secretary Scott Bessent said last night he had a meeting with them. He sounded optimistic. When you look at some of these lines, Chip Roy, I have very strong concerns. I'm not inclined to support this. Ralph Norman, our bill has been completely changed. This bill is a non-starter. Speaker Johnson can only lose 3.
This is the battle going into the weekend. A week today, there's going to be a battle over trade. July 9th, the President of the United States, I'm not thinking about a pause. I'll be writing letters to a lot of countries.
Including Japan, since Japan is evidently the poster child that he'd like to hold up, to beat up, to really show as an example of anybody else.
When did Japan become the new China, the new Europe?
It seems like there always needs to be somebody to be kind of on the whipping post, and right now it's Japan. It's sort of the example maybe to get others on board. I wonder who he's messaging to. Is it the European Union to get on board? Is it India, where negotiations are ongoing? It seems like they just need to hold up some example of badness to sort of get people to comply.
We know this president likes to escalate to de-escalate, take a very maximalist approach. approach. They could be at the final ends of this negotiation, and he's just looking to maximize the concessions out of Japan, maybe when it comes to access to the auto market, when it comes to maybe U.S. rice going into Japan. He says they're spoiled. And why I think this is a negotiating tactic is because he's not even thinking about going back to the 24% initial rate he put on Japan. He's talking about maybe they'll pay 30, 35%. We're going to see, but they haven't been easy to deal with.
Are you going to take some vacation next week? Just take a break from all this.
Maybe. I mean, honestly, this just feels a little bit like kabuki theater. We deal with this all the time. People come out, oh, it's terrible. Oh, my goodness, I'm not going to vote for it. Oh, my God, we're not ever going to have trade again. And then it gets resolved at the last minute, and everybody files into their respective places. And we see that story again and again, and that's where markets are.
Brutal yesterday in markets, wasn't it? Down 1/10%. Oof. On the S&P 500. Snap at a 3-day rally on the S&P. Looking ahead some data later, look out for ADP at 8:15 Eastern Time, the appetizer before the payrolls report tomorrow morning. Payrolls Thursday's just around the corner. The estimate for this morning is 98K. That's the estimate in our survey. The previous number, a low ball, a big downside surprise, 37. That's coming up later. Coming up this hour, we'll catch up with Brian Nick of New Edge Wealth, with stocks sitting near record highs. Ivsita Smolinsky of Capitol Street as the tax bill heads back to the House, and Wei Li of BlackRock on the mega forces driving global markets. We begin this hour with stocks higher, with President Trump's tariff deadline just a week away. Brian Nick of New Edge Wealth writing, we called our mid-year outlook the summer of mud. The U.S. economy is getting weaker at an accelerating rate, and we expect downward revisions to GDP growth to resume. Brian joins us now for more. Brian, good morning.
Thanks for having me.
If that's the case, can you still be constructive equities, and why?
It's hard to be. It's hard to be excited about, for us to be about any segment of the market. We're kind of preaching balance. Most of our investors are underweight international. They're still overweight the U.S. dollar. There's still room to, that we think, improve kind of risk-adjusted portfolio positioning. But to look at small cap in this environment, which has been a laggard, you really can't get enthusiastic about that if you're expecting downward GDP revisions. To look at the large cap that's run up so far so fast in valuation, and to look at long-term returns, which is what our clients tend to be interested in, and say, what do you really hope to get from an upside here with 22 times earnings, 36, 37 times Schiller PE? It doesn't look like an appetizing time. And then you have to look at the other side of the ledger, the bond market. You really have to go into this with your eyes wide open, with the debt situation coming up and the potential that the Fed cutting interest rates at the short end may not do much to cause bonds to rally.
Let's stay on equities first and throw a sector in there. Bank stocks, KBW Bank Index close to all-time highs. Big buybacks. Wells Fargo, Mike Mayo coming out and saying, so long as we avoid recession, it's game on for bank stocks. Is just avoiding recession good enough? Even in a decelerating growth environment, is avoiding recession good enough?
I think if you get some steepening in the yield curve, that's going to help a lot of these stocks too. If you get some benign Fed rate cuts, now we don't think that's all that likely. We think what the Fed's got priced in right now is probably not right. It's either going to be no rate cuts because inflation just comes back in a way that doesn't allow them to move, or it's going to be more like the equivalent of 5 or 6 rate cuts. But if you do get sort of a benign steepening in the yield curve, that can help bank stocks. That probably also means we're not in recession. It probably means we're in more like a 1 to 1.5% GDP world. And we know from history that the stock market can grind higher in that type of environment, even from here, but it's going to be mostly the earnings. So it's going to be, fits and starts inching your way back up, not big lurches like we saw in May and June.
One of the most interesting things is how diametrically opposed different notes are about whether we're going to see upside surprises or downside surprises to the U.S. economy in the next few months. Some people say that the bill that is just being passed in Washington, D.C. will act as a stimulant. I know that you have disagreements with that, Anne-Marie, but in particular, you've got deregulation and you have the expansion of the deficit on the behest, frankly, of corporate profits. Why is that not enough for you?
I think it's going to help in the near term because a lot of the things that are sort of cost savings in the bill don't actually go into effect for a few years. So it's more stimulative. If you look at the CBO, you look at independent, Wharton put out an analysis about this yesterday. It is stimulative in the near term. The question is stimulative into what kind of environment? Retroactive sort of business tax cuts, business tax incentives are going to help earnings this year, is going to help earnings next year. But if we're in a situation where, like we've seen consumer spending negative for the first 5 months of the year, housing prices declining, people becoming less constructive about the labor market, how much of an oomph are we going to get? How much more businesses going to hire and invest with tariff-based uncertainty still, and with a lot of concerns about the economy, independent of what passes in this Congress?
Meanwhile, you talk about the yield curve steepening and what could happen in the bond market. If I were a cynic, I would say every time people didn't understand the bond market, they started to talk about bond vigilantes coming back. There is a sort of theory of the mystery of the bond vigilante who may or may not come back to protest a bill where they don't seem to be anywhere in sight right now. So how do you square that?
What you're seeing, two things happening at the same time. One, the economic data is getting steadily worse. And two, there's this big budget-busting bill that's about to pass. It's even going to be more deficit increasing than the one that passed the House. And if you assume a lot of these trap doors don't get sprung, where we don't actually see things sunset in 2029, we don't actually see, some of these senators don't seem to think the Medicare cuts or Medicaid cuts are going to happen in 2027. If those things don't happen, this bill is even larger. So if you're walking into the bond market right now, you have to do it with open eyes. You have to think short term, I'm going to see enough of a weakening in growth to get the 10-year down to 4.20, maybe down to 4% or below. But that's not going to happen absent a more significant downturn. You're likely to just be clipping your coupons here, if that. And I don't think you're going to see a further rally in the bond market unless the economic data weakens more.
For the record, I do think it's stimulative, but on the margins. This isn't like 2017. The crux of this is extending policy. What it does offer, though, is clarity, because it's clarity that policy is not going to sunset at the end of the year. Doesn't that get you excited? When everyone's talking about all this uncertainty?
The most expensive parts of the bill are just maintaining the status quo, right? So that's not going to be overly stimulative. Somebody whose tax rate was 19%, if that stays 19%, that's not going to stimulate them to do more. And frankly, most people probably don't appreciate that by the end of the year, if nothing gets done, the tax rates are going to go back up. So I don't see it as stimulative, but some of the new business measures, making those permanent, making expensing permanent, that should help. And for some business pass-throughs, like individuals that are tax-like businesses, this is going to give them more incentive to expand those businesses as well. But I agree with you. This is not a huge stimulus bill like the ones that we've seen passed in the last couple of years. This is maintaining the status quo for most of the tax code and doing some spending increases in the very near term and hoping for spending cuts down the road.
As we seek for clarity, would you want to be maybe excited about July 9th then? If the president is saying everyone's getting a letter, I'm not doing any extensions, because at least you'll have clarity and not all the whipsaw of headlines?
Unlike the expiration of the tax bill from 2017, there's no statutory deadline here. This is just arbitrary. And we've seen these deadlines come and go in the past, sometimes with things like TikTok, but also more recently with trade, 30-day extensions on the Mexico-Canada agreements. We're like 90 days into that 30-day extension. So I don't think anything's magical is going to happen necessarily on July 9th. There may be some letters that go out, but the idea that we're going to see all these tariff rates go back up to where the announcement was on April 2nd, I think if people are expecting that, A, it's not incorporated in the markets. So the markets aren't thinking that's going to happen. I think that's a reasonable assumption at this point.
Brian Nick of New Edge Wealth. Brian, thank you, sir.
Thank you.
Getting excited about clarity in the second half to replace all the uncertainty of the last several months.
Well, we need some excitement. I mean, we've had a lot of excitement, don't get me wrong, in the first 6 months.
Right now, won't
Sure.
you?
Well, boring is great, but if you can get excited about something that has some stability or staying power, I think that we all would be excited for that. So, you know, predictability is a good thing.
Take a few summer months. That's what we need right now. A few summer Wednesdays, you know, just really quiet mornings when nothing happens.
Is this what the Fed is asking for? Is this what Jay Powell is saying? We could have maybe cut rates if I knew what the tariff rates were, if we had some clarity. This should be mood music to the ears of the president.
We've been asking guests over the last week or so, what would you take? Extend and pretend, just keep this going on for the next several years, or just say 10% and move on? And a lot of people have just turned around and said, you know what, I'd take 10%, move on. Just move on with the whole thing.
What do corporate executives do when they think about how to arrange their supply chains if they're dealing with a policy that is so ambiguous, that's like holding water? And the answer is it freezes them, and frozen policy is policy, and that, I think, is causing a lot of anxiety.
Will we actually get a resolution a week today or a repeat of April 2nd? It's a week away. Equity futures right now in the S&P slightly positive by 0.1% with an update on stories elsewhere. With your Bloomberg brief this morning, here's Yahara Arnott. Hey, Yahara.
Good morning, John. President Trump's tax and spending bill is back in the House after narrowly passing the Senate with a tie-breaking vote from Vice President J.D. Vance. It's running into resistance from Republicans who don't like some of the changes. Moderates are worried about Medicaid cuts, and ultra-conservatives vow to oppose it over its impact on the deficit. Meanwhile, as you just said, we're just 1 week away from President Trump's self-imposed July 9th tariff deadline. Beyond that date, countries that did not strike deals with the U.S. will see higher tariff rates. The president says he's not considering any delays, and he's renewing his threat to cut off talks and impose higher rates on several nations, including Japan. And Tesla is expected to report another downbeat quarter, with analysts forecasting a 12% drop in sales from a year ago. That would follow a 13% decline in the first quarter. Meanwhile, Tesla shares are off to a rough start this quarter, which just started, as Elon Musk renewed his feud with President Trump over the massive tax and spending bill. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, we're at the 1 yard line.
85 to 90% of this bill is the House-generated product. The Senate made some modifications to it. We're at the 1 yard line in this game that we're going to run it right up the middle and score for the American people.
That conversation up next with Evsita Smolinski of Capitol Street, live from New York City. You're watching Bloomberg TV.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Live from New York City this morning. Good morning. Welcome to the program. If you're just waking up, good morning to you all. Equity futures positive by about 0.1%, bouncing back from losses yesterday of about 0.1%. On the Nasdaq 100 this morning, positive also, and snapping back on a Russell, the small caps up by 0.9%. Under surveillance this morning, we're at the 1 yard line.
85 to 90% of this bill is the House-generated product. The Senate made some modifications to it. They made it more conservative in some places and moderated it a little bit in others. This is no longer just a House bill. It's not a Senate bill. It's the bill of the people, of the hardworking American people, and we are going to deliver it, as you said, Sean, by July 4th. We're at the 1 yard line in this game that we're going to run it right up the middle and score for the American people.
Here's the latest this morning. The big, beautiful bill hitting some resistance in the House as lawmakers return to Washington to vote on the Senate's version of the legislation. Joining us now from Washington is Bloomberg's Tyler Kendall. Now, Tyler, Speaker of the House, Mike Johnson, making this sound quite straightforward. I imagine this is not going to be straightforward through the next 24 hours.
Yeah, hey, John, good morning. This is by no means a done deal, though we are only expecting President Trump to ramp up the pressure from here, which does hold a lot of weight in Washington. We have to keep in mind that this House bill was designed not to ping pong between the two chambers, which means that if House members do want to make changes, they're likely going to have to call what's known as a conference committee on the procedural level, which means the Senate would have to get involved. That's sort of the wonky way of saying that if they do want changes, it's going to take time, and that could ultimately jeopardize that July 4th timeline. Now, we're running into the same issue in the House that we just saw play out in the Senate, which is that mainly Republicans are on board with the tax cut policy in this plan, but they're pretty divided over the spending cuts. And House Speaker Mike Johnson can really only afford to lose 3 Republicans, and he already lost 2 back in May Thomas Massey of Kentucky and Warren Davidson of Ohio, and we're not expecting either of them to budge on their no vote, which means he can only afford to lose one more in addition in order for this to pass. Now, perhaps the most vocal group emerging at the moment is the House Freedom Caucus, who are accusing the Senate of not living up to its agreement for deeper spending cuts by a tune of $500 billion. But I would also keep our eyes on some of those moderate Republicans in some important battleground districts who have raised concerns about the changes to Medicaid. Not necessarily tightening the work requirements, but lowering the Medicaid provider tax, which would essentially mean less federal matching funds for these states that expanded coverage under the Affordable Care Act. In fact, John, 16 of these Republicans signed a letter last week saying that they would not support the bill if it lowered this provider tax. And at this point, we're waiting to see if they're willing to defy President Trump.
Tyler Kendall with the latest down in Washington. More from Tyler in the next hour. What are the odds that we're just going to play ping pong between the House and the Senate for a little while?
I mean, high at this moment, unless they're able to get everyone across the line -3, but likely this can go to conference and at least a week that they'll go through this process of trying to get to one finish line where they both could agree on.
Let's build on that conversation. Ipsita Smolinski of Capitol Street joins us now for more. Ipsita, welcome to the program. I just want to bring you the president's quote. We can have all of this right now, but only if the House GOP unites, ignores its occasional grandstanders, you know who you are. How many so-called grandstanders are there? How difficult is this going to be?
You know, look, and first of all, good morning. Thank you for having me. We have gotten so far. You know, Tyler summed it up really well. We had the House bill ping-ponged over to the Senate bill. What happened in the Senate is that a lot of those tax extensions became permanent. So guess what? The bill got more expensive. And so you had to look for more spending cuts. Medicaid is what took the hit. And of course has been extremely controversial just after, you know, the last 24, 48 hours. Really, it's been Medicaid and a few other odds and ends for sure. So now here we are. The House looks to convene this morning, right, after a marathon rules committee. And I think if all went well, we could see a bill that's passed today. I don't at all rule out what Anne Marie was saying earlier about a conference committee. You know, it might be a more informal conference committee, not the one that we have seen over the last 10 or 20 years where there's actual appointed members and so on and so forth, but more of an informal conference committee among leadership to kind of iron out the details and get it across the finish line.
When you say Medicaid has been hit, what was the biggest blow to the program?
Sure. So I would point to 3 or 4. I would say the Medicaid work requirements saves about $300 billion over 10 years, and that's this requirement that folks in Medicaid, now these are able-bodied adults. These are not pregnant mothers or babies under 1, of course, folks who are going to be required for 80 hours a month to look for job, volunteer work, even schooling counts. It's a pretty light work requirement. However, what we've seen in states that have tried this experiment is that employment doesn't really get boosted, and instead there's a huge paperwork burden where folks can't upload their forms and all of the different verifications. It's almost like filing your tax returns once a month. So people do lose coverage. So that's a biggie. The provider tax is another issue where it's perfectly legal. Medicaid is not a great payer, but what will happen is states will levy a tax on, say, a hospital or a psychiatric facility. Maybe that's $100. Then they turn to CMS in Baltimore and get that matched rate of $100, maybe more. And then that payment goes back to that hospital through the managed care plan or the MCO. Those are companies like Centene, Molina, United Health, Aetna. Those are the plans that play in the Medicaid space. The point being is that has been gamed to the point where that percentage will get taken down from 6% to about 3.5%, going down 50 basis points a year, starting in 2028. Some of these provisions do start in the out years, so there is certainly time to modify them, but that generates a couple $100 billion over 10. The last, I would say, big impact to Medicaid is the state-directed payment program, where states, all kinds of states, red states, blue states, have come to agreements with the Medicare program, CMS, here in Baltimore to have elevated rates. They're not Medicaid. They could be closer to Medicare or commercial rates in order to finance